Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we're diving into The Laws of Wealth by psychologist and asset manager Dr. Daniel Crosby. We're going to uncover what he says is the single biggest secret to investing success. And here's a little spoiler. It has absolutely nothing to do with picking the next hot stock. So the book kicks off with this really strange question. Now you might be thinking, what on earth does that have to do with anything? Well, it turns out this image is the perfect way to capture the central and kind of hilarious paradox of investing.
You see, as weird and uncomfortable as a monkey in a tuxedo might look, Crosby argues that's exactly how mismatched our normal human instincts are for the modern world of finance. We just don't fit.
And this mismatch creates what the book calls the investor's paradox. It's like we've stepped into some kind of Wall Street bizarro world where all the normal rules of life are suddenly flipped upside down.
I mean, just think about it for a second. In your normal, everyday life, if you want to get ahead at work, you put in more hours, right? More work equals more results. If you want to find the best pizza place in town, you follow the crowd. But on Wall Street, oh man, trying harder, trading more, that almost always leads to worse results. And following the crowd, that's just a recipe for disaster. It's a world turned completely on its head.
So this puts us in a really tough spot, a massive dilemma. On the one hand, you absolutely have to invest your money in things like stocks, just to beat inflation and have any hope of retiring one day. But here's the kicker. Your own brain, the very thing you rely on for every other decision in your life, is basically hardwired to make you terrible at it. Which brings us to the biggest obstacle in your investing journey. And I'll tell you right now, it's not a crazy market, it's not some shady CEO, and it's not a lack of information. Nope, it's something much, much closer to home. You know, the investing legend Benjamin Graham said it best decades ago. He said the enemy isn't out there. The enemy is right here. It's us. Our emotional, impulsive, all too human selves are the single biggest thing standing between us and our financial goals.
And you know what? Psychologists actually have a name for all the wealth we sabotage with our own emotional decisions. It's called the behavior gap. It's the very real, measurable difference between how an investment performs and how the average investor in that investment performs. And that gap is created by one thing and one thing only, our own bad behavior.
And this is where it gets really crazy. Just look at how much this gap actually costs us. This isn't some tiny rounding error. We're talking study after study showing that we, the investors, lose between 1% and more than 4% of our returns every single year, just because we panic or get greedy at the absolute worst times.
Okay, if you want a really mind-blowing example of this in action, check this out. The best-performing mutual fund from 2000 to 2010 returned an incredible 18% per year. But the average person invested in that exact fund actually lost 10% of their money. How is that even possible? Simple. They chased the hot returns, piled in at the top, and then ran for the hills the second things got a little bumpy.
So if the problem is literally baked into our psychology, is there any hope? Is there a cure? Well, the book finds a really powerful answer in, well, a pretty shocking place: the global fight against the guinea worm. Okay, so here's the deal with the guinea worm. It was this absolutely devastating parasite that could grow up to 3 feet long inside a person's body. The pain was just excruciating, and the only way people could get relief was by soaking their burning limbs in the village water source. But, and this is the tragic part, that very act of seeking relief is what spread the parasite's larvae into the water, infecting the entire community all over again. For years, everyone was searching for some complex, high-tech cure. But the solution that pretty much wiped out the disease wasn't a fancy new medicine. Nope. It was getting people to follow 2 simple but, let's be honest, gut-wrenchingly difficult behavioral rules. It was about enduring that short-term pain to break the cycle and secure a better future for everyone. And this is where the light bulb goes on, right? The parallel to investing is just, it's perfect. The real disease isn't the market going up and down. It's our own internal parasites of fear and greed. And the cure isn't some complicated financial strategy. It's the disciplined commitment to a few simple behaviors, especially when it feels painful to do so.
Okay, so this whole idea builds into the core of the book, what Crosby calls the 3 laws of wealth. And these aren't rules for managing your money, they're rules for managing yourself.
Rule number 1 is all about this. You've got to control what you can actually control, which is your own behavior. Forget about trying to pick the next big thing. Focus on the stuff that really moves the needle.
how much you save, what your costs are, and how patient you can be. And honestly, the best way to do this is to just automate it. Set up those transfers from your paycheck to your investment accounts and get your emotions out of the driver's seat.
Now, rule number 2 is a fantastic reality check, and it's summed up perfectly by the legendary investor George Soros. He said, if investing is entertaining, if you're having fun, you're probably not making any money. See, excitement is an emotion, and emotion is the absolute enemy of good decisions. If your heart is pounding while you're investing, you should probably just step away. Good investing should feel about as exciting as watching paint dry.
And the research on this is just stunning. I mean, check this out. In one experiment, researchers made participants feel sad. Those sad participants were then willing to overpay for an item by 30% and sell an item for 33% less than a neutral group. That's literally the behavior gap playing out right there in a lab. Our feelings make us buy high and sell low. And that brings us to the third and final law, which is all about totally shifting your focus. It's this: make your life, not the market, your benchmark. So many of us get obsessed with beating some random index like the S&P 500, but that has nothing to do with our actual lives. True success isn't about beating the market. It's about making sure you can fund the life you actually want to live.
This whole idea is called goals-based investing, and it's so powerful because it makes things personal. When you stop thinking of your money as one big, giant pot, and instead see it as different buckets for different goals, the retirement bucket, the kids' college bucket, the new house bucket, it completely changes your perspective. It gives you context. And studies show it makes investors far, far less likely to panic and sell during a downturn, because they can see that a dip in the market doesn't really threaten their long-term plans.
So when you boil it all down, what's the big secret here? It's that building wealth isn't about being some kind of financial wizard. It's not about finding the next big thing. It's about psychology. It's about mastering that monkey in the tuxedo, your own behavior.
And that really just leaves us with one final thought. The market is going to do what it's going to do. That's totally out of your control. But your reaction to it, that is 100% up to you. So the only question that truly matters for your financial future is, what will you do? All right, let's dive into something that's, a little weird. We're talking about the great paradox of investing. It's the simple but frustrating idea that the one thing you have to do to build a secure future, it goes against every single instinct you've got.
So, picture this for me, just for a second. Have you ever seen a monkey in a tuxedo? I mean, a full-on black tie tuxedo. It's a pretty strange image, isn't it? Kind of absurd.
You might chuckle at first, but then it starts to feel a little unsettling. There's just something that's not quite right about it, right? A wild animal in fancy clothes is just completely out of its natural habitat. And that feeling, that's exactly how we should think about ourselves when we try to step into the world of investing. And this, right here, is the investor's paradox. It's this crazy conflict where on one side, you must invest to secure your future. It's not optional. But on the other side, you are psychologically just totally ill-equipped to do it well. Your brain is basically wired to make you a terrible investor. So let's break down why that is.
Okay, so first, let's talk about the first half of that dilemma, the fact that you absolutely have to invest. I mean, why isn't just being a really good saver enough? Let's just imagine for a second a pretty great scenario. Let's say you're doing well for yourself, making a solid $100,000 a year. And on top of that, you are just incredibly disciplined. We're talking you save 10% of that income, $10,000 every single year for your entire career. 40 years straight, from age 25 to 65, you just put that money away. No excuses, no missed years. So after 4 decades of doing everything right, you've got a nest egg of $400,000. I mean, that sounds like a lot of money, doesn't it? But here's where reality hits, and it hits hard. If you plan for, say, a 30-year retirement, that $400,000 breaks down to just about $13,000 a year. That's barely above the poverty line as it is today. But hold on, because it actually gets even worse. Yeah, we haven't even talked about the silent killer of your savings, inflation. That little monster that just eats away at the value of your money over time. Over 40 years, it's not little. It will absolutely destroy the value of that cash. To put it in perspective for you, having $400,000 today is like having around $90,000 back in 1975. So that hard-earned money you saved,
It's not going to have nearly the same buying power when you finally get to use it.
And that's why, as the famous economist Burton Malkiel said, you've got to invest. It's really the only tool we have to get returns that can beat what he called the insidious and corrosive power of inflation. If you just save, you're pretty much guaranteeing that your standard of living is going to go down over time.
Okay, so we've settled that, right? We have to invest. There's no way around it. But now we get to the really tricky part of this whole paradox. See, investing doesn't operate in the real world. It operates in what we're going to call Wall Street Bizarro world, a place where pretty much everything you think you know is wrong. It's seriously like falling down the rabbit hole in Alice in Wonderland. All the normal rules of common sense and intuition, they don't apply here. You know that famous line from the Cheshire Cat? We're all mad here. Well, that perfectly sums it up. You've entered a completely mad world, and if you want to survive, you kind of have to embrace the madness. So what exactly is this Wall Street Bizarro world? Let's define it. It's an environment where the rules are flipped upside down. The future is actually more certain than the present. Doing less gets you more. And the crowd? Oh, the crowd is almost always wrong.
Right, so how in the world are we supposed to navigate this place? Let's dig into these 3 Bizarro laws one by one.
Okay, Bizarro law number 1. The future is more certain than the present. I know, that sounds totally backward. But look at this. In the short term, like a single year, the stock market is basically a casino. You could be up almost 54%, or you could be down more than 43%. It's a total crapshoot. But watch what happens as you stretch out the timeline. Look at 20 years, or even 25 years. Suddenly, the range of outcomes gets way, way narrower. And get this, the worst possible return over any 25-year period was still a positive gain of almost 6% a year. The chaos of the present smooths out into the predictability of the future. Weird, right?
All right, on to Bizarro law number 2. This one's a real mind bender. Do less to gain more. This flies in the face of everything we're ever taught about success, right? Hustle harder. A perfect way to understand this is the soccer goalie's dilemma. During a penalty kick, goalies will leak dramatically to the left or right 94% of the time. Why? Well, because it looks like they're doing something. It looks like they're trying. But the stats show the best strategy is often just to stand still, right in the center. It's called action bias, this deep-seated human need to do something, anything, even when doing nothing is the smarter move.
So, if all that frantic action is actually the enemy, then who are the best investors? You're not going to believe the answer.
So, Fidelity actually did a big study to figure this out. They looked at all their accounts to see who got the best returns. And it wasn't the brilliant traders or the market wizards. No. The best performing investors were the people who were dead. Or the people who had simply forgotten they even had an account. Their secret weapon was literally doing nothing.
And here's some data that really drives home the cost of that action bias. A super famous study found that men tend to trade about 45% more often than women. And what was the result of all that extra activity, all that tinkering and doing something? Well, they ended up underperforming women by 1.4% every single year. Now that might not sound like a lot, but over an entire lifetime of investing, that is a huge amount of money left on the table, all because of that urge to act.
And that brings us to our final Bizarro law. The crowd is not wise. When it comes to investing, following the herd is a recipe for disaster. The behavioral economist Richard Thaler figured out the perfect conditions for making bad decisions. And guess what? Investing checks every single box. Think about it. 1, the benefits are way off in the future, but the costs are right now. 2, you don't make these big decisions very often. 3, you don't get quick feedbacks to know if you made the right call. And 4, the language used is confusing, sometimes on purpose. It's basically a perfect storm for making terrible, emotional decisions, especially in a group. So, here we are, stuck in this bizarre world where all of our natural instincts just lead us astray. So what do? How do you survive? Well, the key isn't to fight against this new world. The key is to adapt to it. There's this powerful story about the Norse settlers in Greenland. They showed up and stubbornly tried to use their old European farming techniques in a harsh, frozen landscape. They completely ignored the wisdom of the local Inuit people who knew how to survive there. And what happened? They failed. They perished. They refused to adapt. And investors who try to force their real-world, everyday habits onto the strange world of the market, well, they suffer the exact same fate. So, what's the survival guide for Wall Street's Bizarro world? It's actually pretty simple, but that doesn't mean it's easy.
Number 1, embrace the long-term view, because that's where things actually become more predictable. Number 2, fight that urge to act. Remember, your patience is your greatest advantage. It's your superpower. And number 3, ignore the noise. The crowd is a terrible guide.
And that really leaves us with one last question. The whole world, everything around us, screams at us to reward frantic effort and constant hustle. But what if, in one of the most important games you'll ever play, the secret to winning is to just do nothing, to learn how to sit still? The real question is, can you unlearn a lifetime of habits to actually come out on top?
Welcome to The Explainer. Today we're digging into a surprising and maybe even a little uncomfortable truth about investing. And it's this: the biggest risk to your portfolio, it might just be staring back at you in the mirror. So let's get into why that is. We're going to start with this really powerful line from the legendary investor Benjamin Graham. This is the guy who mentored Warren Buffett, so he knew a thing or two. And what he understood was that knowing about markets is only half the battle. The other half, the much, much harder part, is understanding ourselves. This one idea really sets the stage for everything we're about to unpack. So, to really get what Graham was talking about, we actually need to go way back in time. There's an ancient story that perfectly explains a very modern problem. Okay, meet Naaman. This guy was a big deal, a respected, wealthy, powerful army captain. I mean, by all accounts, he had it all. Except he had one huge problem he just couldn't solve. He suffered from leprosy, a dreaded and back then incurable disease. So after trying everything else, Naaman goes to find a holy man named Elisha, who was known for working miracles. But instead of some big dramatic ceremony, Elisha just sends a messenger out with this shockingly simple instruction: go and wash in the river Jordan 7 times. That's it. Naaman is furious. I mean, absolutely enraged. First off, he's insulted the prophet didn't even come out to see him in person. And second, the cure just sounds ridiculous. Wash in the muddy, unimpressive river Jordan? He storms off, ranting about how much nicer and cleaner the rivers are back home. You see, in his mind, a big, complex problem had to have a big, complex solution. But then his servants step in. They basically say to him, hey, if the prophet had asked you to do some great, difficult thing, you would have done it in a heartbeat, right? So why not just try this simple thing? And, humbled, Naaman goes to the Jordan, does what he was told, and he's completely healed. So, what on earth does an ancient story about a muddy river have to do with your investment portfolio? Well, as it turns out, everything. Naaman's story perfectly illustrates what we can call a river Jordan problem. It's when you have a seemingly complex issue that has a really simple solution. A solution we often ignore or even get angry about precisely because it's so simple. And as investors, we face a massive one of these. We look everywhere for the secret sauce to getting rich. We hunt for complicated strategies, hidden stock picks, ways to time the market. We're looking for that miracle cure. But we totally ignore the simple, overlooked problem right in front of us, which is our own behavior. We love to daydream about these heroic investment wins, don't we? Buying Apple in day one, getting out right before a crash, being a ground floor investor with Buffett. But here's the reality check. The single best predictor of long-term wealth isn't genius, it's just sound behavior, patience, discipline, and not freaking out. And listen, this isn't just some philosophical idea. It has a real, measurable cost. The gap between what the stock market earns and what investors actually keep in their pockets is shockingly wide. And pretty much all of it comes down to behavior. So let's actually put a number on this. Just how much money are we leaving on the table simply because we can't get out of our own way? Okay, check out the data from a famous study by a group called Dalbar. It looked at 3 decades of investing. Over that time, the S&P 500 returned about 11% per year. Pretty good. But the average person invested in stock funds, they only made 3.69%. Less than 4. That massive gap is the cost of bad decisions year after year. And it's not just one study. As you can see here, lots of research has tried to measure this behavior gap. The estimates vary a bit, but they all point to the same thing. Investors consistently give up a huge chunk of their potential returns because they make emotional, poorly timed choices. I mean, think about the irony here. If some company launched a new fund and guaranteed it would give you, say, 4% extra returns every single year, people would be lining up around the block to invest. But the crazy thing is, you can earn that premium all by yourself. not by picking some magic fund, but simply by managing your own actions. Now, to see just how destructive our behavior can be, let's look at a dramatic, real-world example. This is a story about how picking the absolute best possible fund can still lead to huge losses. So for a whole decade, from the year 2000 to 2010, a fund called the CGM Focus Fund was the single best-performing stock fund in the entire United States. It absolutely crushed the competition. Get this, it delivered an incredible 18.2% return per year for 10 years. You literally could not have picked a better place to put your money. So you'd think everybody who invested in this thing got rich, right? Well, here's the million-dollar question. What did the average investor in this number one fund actually earn over that time? They lost 10%. No, that is not a typo. The number one fund in the entire country produced a 10% loss for the average person in it. How is that even possible? Here's how. The fund was extremely volatile. It had huge ups and downs. So investors did what investors do. They chased performance. They'd see these massive returns and pile their money in after the big gains had already happened. Then, when the fund inevitably had a bad stretch, they'd panic and sell out right at the bottom. They perfectly executed the textbook losing strategy: buy high and sell low, over and over and over again. So the takeaway here is crucial. The solution isn't to find a better fund that's less volatile. The solution is to adopt better behaviors. And just like Naaman's cure in that muddy river, the fix is surprisingly simple. Here are 3 simple steps you can take to overcome your own River Jordan problem. First, think. Just internalize this idea. Your own choices matter way more than what the market does day to day. Second, ask yourself better questions. Instead of trying to find the next hot stock, focus on what you actually control, like saving more or just being more patient. And finally, do. Automate your investing. Set up those regular, automatic contributions and just let the system work for you. It takes the emotion right out of the equation. At the end of the day, we spend so much time and energy looking for secrets in the market, when the real key to better returns is sitting right here, with us. It's not about finding a bigger, better river. It's about having the humility to just follow a simple plan. That control is in your hands. So the only question left is, what are you going to do with it? So here's a question we're all grappling with these days. In a world where you can trade stocks for practically nothing and all the financial information you could ever want is on your phone, is a financial advisor just an expensive habit? Or are they a crucial partner? Let's dig in. You know, the Roman philosopher Cicero wrote something that really hits home here. He said, "Not for ourselves alone are we born." It's this timeless idea that for the really big things in life, we often need a guide. And that, right there, is the perfect setup for our question today. Is handling your financial future one of those things? Because let's just get real for a second, this is the question, isn't it? When you can buy pretty much any investment you want from your couch for free, the idea of paying someone a percentage of your money year after year, it feels a little outdated. Is it just something we do out of habit, or is there some real value that we're missing? To really get to the bottom of this, we've got to first look at the old way of thinking. For decades, the financial advisor was kind of seen as this all-knowing guru, right? They were the gatekeeper to this secret club of wealth. Well, that gate has been completely blown off its hinges. I mean, this says it all, right? 30 years ago, your advisor was the guardian of all the data. They had the keys. Today, all of that information and more is literally in your pocket. That old job of just being an information broker, it's gone. It's totally obsolete. So if you're not paying for information anymore, what are you paying for? Okay, this is where the story takes a really interesting turn. Because just as that old value disappeared, a brand new one that's backed by a ton of research, has stepped up to take its place. So let's talk about the reality of what good advice is actually worth. You'd think the data would be all over the place on this, but it's not. The answer to, is it worth it, is a surprisingly clear yes. But, and this is a big but, the reason why is probably not what you're thinking, and it might just change the way you look at this whole relationship. So let's start with a study from, of all places, Vanguard. You know, the company basically built on the idea of low-cost investing. In this landmark paper called Advisors Alpha, they figured out that a good advisor adds about 3% in net returns per year. Coming from Vanguard, a number that big is absolutely staggering. And hey, that's not just a one-off study. Morningstar did their own deep dive. They even came up with a name for it, Gamma, the value you get from making smarter financial decisions. And their number, 1.82% of extra performance every single year for people who get advice. The evidence is just piling up. Professional guidance really pays off. Okay, so where does all this value actually come from? Well, Vanguard broke it down for us. Asset allocation? Yep, adds value. Rebalancing your portfolio? That helps too. But look at this. Behavioral coaching is worth 150 basis points. That is literally more than the other two combined. And this is the light bulb moment. The single biggest value your advisor brings to the table is just stopping you from doing dumb stuff with your money. Now, a couple of percentage points a year might not sound like a game changer, but this is where the eighth wonder of the world, compounding, comes into play. That little edge turns into a life-changing amount of money over time. Let's see what that actually looks like. It is so easy to just dismiss a 2 or 3% difference in 1 year. Who cares, right? But when that edge happens again and again, year after year, it doesn't just add up, it multiplies. And the effect over an entire career of investing, it's just massive. Just look at this data. After only 4 to 6 years of getting advice, investors had 1.5 times more wealth. Stick with that advisor for 7 to 14 years, and you've pretty much doubled your money compared to someone going it alone. And for the really long-term folks, 15 years or more, they ended up with an incredible 2.73 times the wealth. That is the power of having a coach in your corner. The financial side is obviously huge, no doubt. But let's be real, money is just a tool, right? What about the actual impact on your quality of life? Your sleep at night factor? The research here is just as powerful. We can call this the confidence dividend. And just look at the difference here. It's night and day. People with a financial plan are almost twice as likely to have peace of mind. They're more than twice as likely to feel ready for an emergency, and nearly 3 times as likely to feel prepared for retirement. That is a life-changing difference in just feeling secure and confident about your future. Okay, so the data is pretty clear. The right advisor is absolutely worth it. But that word right is doing a lot of heavy lifting there. Not all advisors are the same. So how do you find someone who's less of a stock-picking guru and more of that behavioral coach we've been talking about? Well, here's a 10-point checklist that'll help you find that perfect fit. All right, let's fire through the first 5. Number 1, are you a fiduciary? This is a deal breaker. It means they have to, by law, put your interests first. Number 2, how will you keep me from being my own worst enemy? This question gets right to the heart of it. Do they see themselves as your coach? Then, of course, you got to know how they get paid, if they specialize in people like you, and exactly what they're going to do for you. And for the last 5, ask about their credentials for sure. Ask about their investment philosophy. It should be simple and make sense, not some secret sauce. Figure out how often you're actually going to talk to them. Ask them what makes working with them special. And here's a great one. What's your succession plan? If they're asking you to plan for the next 30 years, you'd hope they've done the same for their own business. So, after all this data, all this analysis, we land on one central, simple idea. And it's best explained by something called the River Jordan problem, which just perfectly sums up why so many of us miss out on the real value of advice. So what in the world is a River Jordan problem? It's basically any problem that has a really simple, really effective solution that we tend to ignore precisely because it feels too simple. For a complex thing like investing, we think we need a complex solution, right? We chase complicated strategies when the simplest solution of all, just managing our own behavior, is sitting right there in front of us. And this quote, man, this just says it all. This is the big mental shift. You're not hiring a money manager. You're hiring an emotions manager. You're not paying for hot stock tips. You're paying for someone to save you from yourself when the markets go crazy. Because when you boil it all down, this is it. We all know we should eat better and exercise more. We all know we're supposed to buy low and sell high. But just knowing something isn't enough to make us do it, especially when panic and greed are screaming in our ears. For that, you don't need more knowledge. You need a coach. So we'll leave you with this final thought. If you can accept that an advisor's main job is to be your behavioral coach, it changes everything. You stop looking for a stock market wizard and you start looking for a wise counselor, Someone who knows their stuff, for sure, but more importantly, someone you trust to talk you off the ledge. And finding that person, well, that might just be the single best investment you ever make.
Welcome to The Explainer. You know, we're always told to save for a rainy day. But what if I told you that in the world of investing, the rainiest days, I'm talking thunder, lightning, the whole storm, are actually when fortunes are made? Today, we are digging into one of the fundamental laws of wealth, why financial trouble is almost always a golden opportunity.
So let's start with this classic piece of wisdom from the legendary investor Sir John Templeton. It sounds so simple, right? So completely logical. Be greedy when others are fearful. We've all heard it 1,000 times.
But if the path to success is so clearly marked, why is it so incredibly hard to do? Why do so many of us end up doing the exact opposite? Why does our gut just scream sell the moment the headlines get scary and it feels like everyone is panicking?
Well, it turns out the problem isn't really our financial strategy. The problem is us. It's our fundamental human wiring. Our brains, you see, were built for surviving on the savannah, not for calmly navigating a bear market.
Okay, to really get what's happening inside our own heads, let's try a quick thought experiment. And I want you to actually do this, okay? Pause if you need to. First, take 30 seconds and just jot down a few things that could make your day significantly better. Got a few? All right. Now, for the next 30 seconds, I want you to list things that could make your day much, much worse.
Now take a second and look at those two lists. If you're like pretty much everyone else, that worst day list was probably longer, way more specific, and felt a lot more real, didn't it? It's just easier for us to imagine disaster than it is to imagine good fortune. And that's not a flaw. It's a feature, a survival instinct. We are literally hardwired to scan for threats.
So we are naturally wired to worry. This is not a secret. In fact, our tendency to focus on the negative is so predictable that it's often exploited by a group you could call the panic profiteers. This quote just hits the nail on the head, doesn't it? I mean, think about the news alerts on your phone. The financial media knows that fear gets clicks. Headlines like "market crash looms" or "recession inevitable." They amplify our natural anxiety, and they create this constant storm of crisis that makes it almost impossible to think clearly.
So, how in the world do we fight this constant stream of panic? Well, you don't fight emotion with more emotion. You fight it with cold, hard facts. Let's look at the actual data and see how all this chaos that we see is really just part of a surprisingly predictable pattern. It's time to inoculate ourselves against the fear.
First, let's just get the language straight. The media loves to throw these terms around to sound scary. A correction is a 10% drop from the top. A bear market is a 20% drop. They're just percentages. But what do they actually mean in practice?
Okay, take a look at this number 123. That's not random. That's the number of market corrections, those 10% or more drops, that the U.S. stock market experienced between 1900 and 2013. Just let that sink in for a second. This isn't some rare black swan event. It's a routine part of how the market functions.
Let's break that down even further. A 10% drop happens, on average, once a year. A bigger, scarier 20% drop, a bear market, happens about every 3.5 years. So despite the drama and the breathless headlines, these downturns are not anomalies. They show up as regularly as spring flowers.
This, right here, this is the mindset shift. This is the sentence you need to burn into your brain. Maybe even write it down. Bear markets are a natural part of the economic cycle, and I should expect 10 to 12 in my lifetime. You see, when you truly expect them, they stop being a terrifying surprise. They just become another predictable milestone on your journey.
And once you understand this regularity, you can start to see how fear creates this massive gap. It's the gap between how the stock market actually performs over time and how the average investor performs. Why? Because we get scared and we buy high and sell low. Just look at this table. It shows the brutal, painful history of major U.S. bear markets. And yeah, the numbers are scary. Some were short and sharp, like 1987. Others were these long, grinding downturns. The average drop was a staggering 45%. So yes, they are painful, and they are always different. But look for the one constant. They all end. Every single one of these catastrophic events was eventually followed by a full recovery and new highs. Every single time.
Let's look at this perfect, painful example from 2002. For 5 months in a row, investors were fleeing the market in record numbers. The panic was real. And when did that wave of selling peak? October 2002, the exact literal bottom of the market. They sold at the point of maximum pain and missed a nearly 100% gain over the next 5 years. That, right there, is the behavior gap in action.
It's like Warren Buffett's mentor, the great Benjamin Graham, explained. Your biggest advantage as a long-term investor is time. But when you react to fear, when you panic sell, you perversely turn your greatest strength into your single biggest weakness. You lock in your losses and you miss the entire recovery.
Okay, so that's the problem. We're wired for worry, the media exploits that worry, and we end up shooting ourselves in the foot. So, the big question is, how do we fight back? How do we protect ourselves from our own worst instincts and actually turn this knowledge into a real advantage?
The secret is surprisingly simple. It's expectation. Think about it. You can't tickle yourself, right? Why is that? Because your brain anticipates the sensation. The element of surprise is gone. It's the exact same principle with the markets. If you truly expect volatility, if you know a correction is a normal yearly event, it just loses its power to shock you into making a bad decision.
So, what do you do now? Here's your practical 3-step toolkit for the next time things get chaotic. First, you have to think differently. See the volatility not as risk, but as the price of admission for strong returns. Second, you need to ask the right question when everyone else is freaking out. Where is the opportunity for me in all this? And third, you have to do the work before the storm hits. Create that dream list of high-quality companies or funds you'd love to own, because the next panic is when everything on your list finally goes on sale.
And that brings us right to the final and most important question. We know for an absolute fact that another downturn is coming. It's not a matter of if, but when. So knowing everything we've just talked about your own psychology, about the media's playbook, and about market history, the only question left is this. When that next panic arrives, will you be ready? Will you join the stampede of sellers, or will you be the one with a plan, ready to buy?
Welcome to The Explainer. Today, we're going to break down one of the most counterintuitive rules in all of finance. And that's the idea that if you're feeling excited about an investment, if you have that great gut feeling, it might actually be your portfolio's single worst enemy. Okay, so let's just dive right in with a little thought experiment. I want you to listen to a sound. Ready? The sound is dahi. How would you spell that? Don't overthink it, okay? Just what's the very first spelling that pops into your head? You got it? All right. So whether you spelled it D-Y-E or D-I-E, well, that actually says a surprising amount about the mood you're in right now. It's kind of wild, but our emotional state literally colors everything, even something as basic as which word our brain grabs first. A good day, you think of color. A tough day, well, something a little more final. And what this little test really shows is that our brains are not these objective, impartial computers we wish they were. Honestly, they're much more like a pair of beer goggles, constantly twisting and warping how we see reality based on how we happen to feel at that moment. And when the stakes are high, like with your life savings, that's a really dangerous thing.
You know who understood this perfectly? The legendary investor George Soros. And his take on this is really our guiding principle today. That feeling of excitement, of fun, that makes you want to smash the buy button, that's often the biggest red flag there is. Because good investing is methodical, it's researched, and yeah, it's usually pretty boring.
So let's look at the hard evidence. I mean, it's one thing to talk about feelings, but how much can they actually cost us in, actual dollars and cents? There was this fascinating study by a psychologist, Jennifer Lerner, who wanted to measure the financial impact of just one emotion, sadness. So she took one group and made them sad by showing them a tragic movie clip. The other group watched a totally neutral clip about fish. Then she had them do something that seemed completely unrelated. The results were pretty shocking. When she asked them to name a price to buy a simple highlighter pen, the sad group was willing to pay 30% more than the neutral group. It's like their sadness created this urge to go out and acquire something, to overpay, just like when we do a little retail therapy after a bad day. And here's the kicker. It was just as bad on the other side. The sad participants who were asked to sell the exact same highlighter were willing to accept a price that was 33% lower than their unemotional counterparts. They just wanted to get rid of it. Now just imagine that huge 30% swing when it's applied to your house or your stock portfolio. Yikes. But look, it's not just about being sad. The behavioral economist Dan Ariely ran a different kind of experiment to see what happens when we're in what he calls a hot state. And that's any state of high emotion. Could be excitement, could be anger, you get the picture. And what he found was a dramatic shift. In a calm, cold state, yeah, people make rational choices, they stick to their moral code. But get them into an emotionally charged hot state, they become completely different people. They were 136% more likely to cheat. It's like all their personal rules about morality and self-protection just disappeared. So this is the really crucial point. As the trading coach, Dr. Brett Steenbarger puts it, under emotional pressure, we don't just break our rules, we literally forget that they even exist. So it doesn't matter how smart your investment plan is. The second you get emotional, you become a complete stranger to that plan.
So where do these powerful emotions even come from? Well, a lot of the time, they get triggered by something equally powerful and, frankly, dangerous. A really good story.
And this is the core mechanism. I mean, you can show someone all the data, all the logic in the world, but a compelling story, it acts like a Trojan horse. It just slips right past all our rational defenses and delivers a big payload of emotion directly into our brain's decision-making center.
Let me give you another quick example. Look at this thing. How would you value an old, single-sequin glove? $10? Maybe 20 as a gag gift? It's probably not worth much, right?
But what if I told you it was worn by Michael Jackson? See, in an instant, with that one tiny piece of story, its entire value just completely changes. It's not about the fabric and sequins anymore. It's about the narrative, the history, the emotion. The story is what creates the value.
And this isn't just a theory. There was this amazing social experiment called the Significant Objects Project that proved it. Researchers bought about $130 worth of random junk from garage sales. Then, they had professional writers invent these compelling, totally fictional backstories for each item and sold them on eBay. The result? They sold all that junk for over $3,600. That's an increase of more than 2,700%, purely because of a made-up story. Now, this very human weakness for a good story can have disastrous consequences in the investing world, especially when it comes to exciting new companies going public, IPOs. They are always packaged with a fantastic story about growth and innovation. But what does the data say once you strip that story away? Well, the average IPO in the US goes on to underperform the market by a staggering 21% per year for the first 3 years. That exciting story you bought into is, on average, a one-way ticket to losing money. Ultimately, this is the chain reaction that happens. The exciting story makes us impatient. We want that huge gain, and we want it now. And that impatience leads to terrible decisions. Chasing hot stocks, selling at the first sign of trouble, it's a recipe for going broke.
Okay, so the problem is pretty clear. Our brains are kind of wired to make bad financial decisions when we get emotional. So what do we do about it? How do we fight back and protect our investments from ourselves?
The very first step is just a simple change in mindset. You should adopt this as your personal mantra. Think of it as a cognitive circuit breaker. Anytime you feel a strong emotion about a stock, fear, greed, excitement, you just repeat this to yourself. It reminds you that the person feeling that emotion is not the rational you who built the smart plan. Next, before you make any transaction, just stop and ask yourself this one critical question. The simple act of just naming the emotion is incredibly powerful. It forces that thought out of your reactive, emotional brain and kicks it over to your logical, analytical brain, which allows you to see it clearly for what it is, which is usually just a distraction. And finally, here's a fantastic practical strategy. You have to acknowledge that the urge to act on emotion is never going to fully go away. So don't try to kill it, contain it. Create a small, separate play account, maybe 3% of your total wealth. This is your sandbox. It's a quarantine zone for financial viruses like FOMO and greed. It lets you satisfy that itch to get excited without risking your serious long-term investments. And we'll leave you with this final thought to chew on. Take an honest look at your own investments. Are they built on a foundation of boring, methodical logic? Or have you, maybe without even realizing it, bought into a few too many exciting stories? Knowing the answer to that, well, that's the first and most important step to becoming a much, much better investor. All right, let's get right into it. We're about to tackle one of the toughest, but maybe one of the most important rules in all of investing. And it's a really simple and, kind of provocative idea. What if the belief that you are special is the single biggest thing holding you back from financial success? To really set the stage for this, just let this quote sink in for a second. It's harsh, right? But this idea that we're not some unique snowflake is the exact medicine we need to hear if we want to get better at investing. There's a fascinating comparison that comes from the world of therapy. The famous therapist Irvin Yalom said that sometimes to help a patient, he has to be love's executioner to help them see reality clearly. Well, as an investor, you have to do the same thing to your own ego. You have to become your ego's executioner. The whole goal here is to get past that deep-seated feeling that somehow the rules just don't apply to you. Now look, this isn't just some philosophical idea I'm throwing out there. It's a well-documented cognitive error. Let's actually look at the evidence, because it turns out our brains are practically hardwired to believe we're just a little bit better than we actually are. So let me ask you, how's your sense of humor? If you're like pretty much everyone else, you probably think it's, pretty good. But get this, a staggering 95% of people believe they have an above-average sense of humor. I mean, you don't have to be a math whiz to know that is completely statistically impossible. And this isn't just about telling jokes. This overconfidence bug spreads everywhere. One study found that a full 100% of men thought their interpersonal skills were above average. 100%. And 94% felt they were better than average athletes. It even shows up in school. American students rank #1 in the entire world for confidence in their math skills. But their actual ability, that's just kind of middle of the pack. It's this gap, this huge space between our confidence and our actual reality. That's where all the danger is. And boy, does this confidence bias get dangerous in the world of investing. Just look at this Gallup survey from February 2000. I mean, this is the absolute peak of the dot-com bubble. It's so telling. Investors at the time expected the market to return about 13%, but they expected their own portfolios to return over 15%. See? Every single one of them thought they were the special one who could beat the market. So what's driving this? Well, it's a funny little psychological quirk called the fundamental attribution error. It's basically a mental shortcut where, when we succeed, we credit our own genius. But when we fail, that's just bad luck. But for other people, we do the complete opposite. Here's a perfect example from daily life. Let's say you cut someone off in traffic. Why'd you do it? Well, you were running late, you didn't have your coffee yet, it was the situation, right? But if someone else cuts you off, that guy's a terrible driver, just a total jerk. It's his character. We give ourselves a pass, but we judge everyone else pretty harshly. In this error right here is precisely why we are so bad at learning from history. When our stocks go up, our brain says, see, I'm a genius. But when they crash, we blame the Fed or the markets or some algorithm. We never actually internalize the lesson. And as the legendary investor Jeremy Grantham puts it, this is why, in the long run, we learn nothing at all from even the biggest market crashes. Okay, so we've established the psychological problem is real. But what are the actual real-world consequences? Well, this overconfidence doesn't just puff up our ego. It makes us dangerously careless with our actual money. It really all comes back to Warren Buffett's 2 incredibly simple rules. While most of us are dreaming of hitting that investment home run, the truly great investors are relentlessly, obsessively focused on not striking out. Defense, not offense, is what wins championships in the long run. And that really is the core of the issue. The belief that I'm special doesn't just make us dream a little bigger about our potential gains. The much, much more dangerous part is that it makes us completely underweight the probability that something bad could happen. We become blind to risk. And of course, the data backs this up perfectly. There was this one study where people were asked to rate the likelihood of different life events happening to them. The results were crystal clear. We consistently overestimate the chance of good things happening to us by about 15%, and we underestimate the probability of bad things happening by a full 20%. We do this all the time without even thinking about it. Good things, like, say, winning the lottery, that's something that could happen to me. But bad things like getting divorced or losing a ton of money in the stock market, well, that's what happens to other people, to the schmucks, not to me. I'm special, remember? The economist J.K. Galbraith just summed this up perfectly. He said it's not just fools who lose their money, it's also those who get captured by this dangerous sense of their own brilliance. Arrogance is expensive. So, what do we do? How in the world do we fight a bias that seems so deeply baked into our nature? Well, believe it or not, the ancient Romans had a pretty brilliant solution, a sort of behavioral intervention for hubris. Just picture this scene. A Roman general has just won a massive history-making victory. He is at the absolute peak of his success, being paraded through the streets of Rome in a glorious triumph. The crowds are roaring. It is without a doubt the greatest day of his life. But right there, in the very same chariot, standing right behind this celebrated hero, was a slave. And this slave wasn't there to hold a trophy or fan the general. No, he had one single, incredibly important job. His entire purpose was to lean in through all the cheering and the celebration and whisper a constant, grounding reminder into the general's ear. A phrase designed specifically to keep him grounded, to hedge against that pride that always seems to come right before the fall. So what did he whisper? Memento mori. Remember, you will die. Even on the greatest day of his life, the general was reminded of his own mortality, his own imperfection. It was a stark reminder that luck can and absolutely will eventually turn. And the slave would also say, look behind you and remember that you are only a man, not a god, not special, just a man. This was the ancient Roman system for checking your ego right at the highest level. Now, we might not have chariots or slaves whispering in our ears today, but we can build our own system for humility. We can be our own Roman slave, whispering these grounding truths to ourselves as we try to navigate the markets. Here's a super simple, actionable 3-step plan. First, think a simple thought. I am not special. I'm just as vulnerable to making dumb mistakes as everyone else. Second, ask a skeptical question. If this stock is such a sure thing, why is somebody else selling it to me? What might they know that I don't? And finally, and this is the most important one, do. Stick to your written financial plan. A plan is a system. It takes your ego and those gut feelings of superiority right out of the equation. So I'll leave you with this one question to think about. The next time you make an investment decision, just take a moment and honestly ask yourself, who's in the driver's seat here? Is it your thoughtful, disciplined financial plan? Or is it that little voice in the back of your head whispering that you're a beautiful and unique snowflake?
Have you ever checked your portfolio and just felt that sinking feeling because you're not beating the S&P 500? Yeah, we've all been there. But what if that's the wrong game entirely? Today, we're going to flip that idea on its head and talk about a benchmark that actually matters, your own life.
So let's kick things off with this amazing quote from H.L. Mencken. It's funny, yeah, a little cynical for sure, but it just hits on this massive truth, doesn't it? Our sense of whether we're doing well is so often tied not to what we actually need, but to how we think we stack up against everyone else. And that really gets you thinking, right? Why? Why are we so hardwired to constantly compare ourselves? Is it some kind of personal flaw? Or is there something, deeper? Something biological happening inside our own heads?
Well, it turns out it's not just you. This urge to compare is a fundamental part of our biology. We're all caught in what you might call the comparison trap. And the reason for it is, quite literally, all in your head.
Okay, so the science behind this whole comparison thing, it comes down to these fascinating brain cells called mirror neurons. When scientists were studying macaque monkeys way back when, they found something incredible. The exact same neurons fired whether a monkey reached for a nut itself or just watched another monkey do it. It's like, in our brains, the line between doing something and just seeing it happen basically disappears.
And this one simple discovery explains so much about us. It's why you can't help but yawn when you see someone else do it.
It's also the very basis for empathy. When you're watching a sad movie, your brain isn't just observing a character's sadness. On some level, it's actually experiencing it with them. And you can see this wiring play out everywhere in our culture today. I mean, it's why millions of people get a real, genuine thrill from watching a total stranger on YouTube unbox a new phone. Our mirror neurons are giving us a little taste of that same excitement.
Now, this ability to feel what other people feel is obviously crucial for building communities. But here's the thing. When you take that same wiring and apply it to your money, oh boy, that's when things can get really disastrous. This is what we call the madness of crowds, and it's where comparison can become incredibly costly.
And there is no better story about this than the one about Sir Isaac Newton. Yes, that Isaac Newton, the genius who figured out gravity. So in early 1720, he invested in the South Sea Company and made a really nice profit. And he did the smart thing. He sold his shares. But then he had to sit there and watch as his friends and his neighbors, who all stayed in, got fabulously, ridiculously richer. That social pressure, that fear of missing out, it just became unbearable for him. So he jumped back in, piling all his money into the stock right at the very top. And when the bubble burst, he lost a fortune.
And after this whole mess, Newton himself reportedly said, "I can calculate the movement of the stars, but not the madness of men." That is such a powerful lesson. I mean, if one of the most brilliant minds in human history can fall for this herd mentality, what chance do the rest of us have if we don't actively fight against it?
So, what's the big takeaway here? It's this. We have to completely change our goal. Investing isn't a competitive sport where you're trying to beat the market or your brother-in-law. It's a single-player game. The only opponent you really have to master is yourself.
Which brings us to the solution. Okay, so if the old way of keeping score is broken, what do? We have to build a new one by creating a benchmark that's actually meaningful. Your life, your benchmark.
Well, there's a name for this approach. It's called goals-based investing. And the idea is actually beautiful in its simplicity. Instead of asking, hey, did my portfolio beat the market this quarter, you start asking a much more important question. Am I on track to pay for the life I actually want to live?
So let's just put these two approaches side by side. Trying to chase a market benchmark is what some people call the Procrustean fallacy. And, it gets its name from this pretty gruesome character in Greek mythology who would make his guests fit into his one-size-fits-all bed by either stretching them out or chopping off their legs. It's a horrible image, but it's exactly what we're doing when we try to force our unique financial lives to fit some generic market index. A personal benchmark, on the other hand, is completely custom-made for your values, your timeline, and your needs.
Okay, this all sounds great in theory, right? But does it actually work when things get tough? During a crisis? Well, let's look at what happened during the ultimate stress test, because the proof is right there in the data.
And this data just says it all. During the 2008 financial crisis, a firm called SEI Investments tracked how their clients were behaving. And I mean, just look at this. The difference is absolutely staggering. A huge number of traditional investors totally panicked and sold their stocks. But the goals-based investors? Almost all of them stayed the course. Why? Because they had a plan that was bigger than the fear of the moment.
So, what was their secret? Why were they so much calmer? Well, it's because this approach helps you build a kind of financial hierarchy of needs, a lot like Maslow's famous pyramid you see here. Think about it. You can't be planning for your legacy if you're worried about keeping the lights on, right? So by making sure your foundation is secure first, things like food and shelter, you get the peace of mind to let your longer-term goals, like college for the kids or that dream car, ride out the market's ups and downs.
All right, so let's get into the good stuff, the how-to. How can you actually start doing this for yourself? Let's walk through building your own benchmark and really putting your money to work for your life.
It all starts with this really cool psychological idea called mental accounting. And it's super simple. The label you put on your money completely changes how you think about it. For instance, studies have shown people are way more likely to save money when you call it a rebate than if you call the exact same amount of money a bonus. The way you frame it is everything.
And this is where goals-based investing gets really clever. It uses this idea through a super simple process called bucketing. You literally create different pools of money and give them each a specific job. So bucket number 1 is for safety. This is the money that gives you peace of mind for your immediate needs. Bucket 2 is for your medium-term goals, things like vacations or college. And bucket 3 is for your long-term legacy. Just by giving your money a name, you give it a purpose. And that purpose is what guides your behavior when things get chaotic.
So where do we go from here? What do you do now? It really boils down to 3 things. First, think. Start worrying less about the global economy and more about your economy. Second, ask. The next time you see a scary headline, just stop and ask yourself, does this news actually change anything about my specific long-term goals? And third, do something. Start the process of bucketing your assets,
even if it's just on a piece of paper or in your head, to line them up with what you really want out of life.
And at the end of the day, it all comes down to this one simple but really important question you have to ask yourself. When it comes to your financial life, are you playing your own game by your own rules, or are you letting someone else play it for you?
We're constantly being told where the market is headed next, right? But what if the entire game of financial forecasting is just fundamentally broken? Today, we're going to dig into why predicting the market is a fool's errand, and more importantly, what you should be doing instead. And this quote from Lao Tzu, man, it just sets the stage perfectly. It gets right to the heart of this deep conflict between really knowing something and just making a prediction. And believe me, when we're talking about finance, this couldn't be more true. Okay, so before we get to the stock market, let's try a little forecast of our own. Just imagine a genie appears, maybe a slightly disappointing genie with only 2 options, and gives you this choice, the money or the walk. Which one do you think is going to make you happier? Now, let's be honest, most of us, myself included, we'd probably take the cash, right? But here's the twist. The research is actually super clear on this. That regular walk, it does way more to improve happiness and quality of life. So think about that. We can't even correctly predict something as personal, as familiar, as our own well-being. And that brings up a really crucial point. I mean, if our own internal wiring messes up a simple choice like that, what possible chance do we have of predicting the future of a system as insanely dynamic and chaotic as the stock market? A system with millions of people making decisions every second? The track record, as you're about to see, is, it's abysmal. All right, Section 1. Forecasting by coin flip. Look, we're not talking about anecdotes or feelings here. The hard data on just how badly these forecasts fail it's absolutely staggering. Okay, let's start with just the sheer scale of how wrong they get it. Get this. Research by investor David Dreman found that a staggering 15%, almost 60%, of Wall Street's big consensus forecasts missed their targets by more than 15%. That's not just a little off, that's an ocean away from reality. Oh, and it gets worse. A lot worse. Someone looked at nearly 80,000 different estimates, and you know what they found? The chance of an analyst's forecast being within a pretty tight 5% range of the actual number was a minuscule 1 in 170. I mean, your odds are basically 0. It's just not happening. All right, one more for you. A study looked at one-year forecasts from the top analysts. We're talking about over 1,000 companies. And on average, they were off by a whopping 31.3% every single year. They are consistently inconsistent. So let's talk about the real-world damage here. Just look at these 2 pivotal years. In 2000, right as the dot-com bubble was bursting, analysts were predicting a massive 37% gain. What happened? The market fell 16%. Then there's 2008. On the eve of the great financial crisis, they're forecasting a 28% gain. The market? It collapsed by 40%. See, they weren't just wrong. They were spectacularly, catastrophically wrong. So the conclusion here is just, it's unavoidable. The research couldn't be clearer. The entire premise of investing based on forecasts is built on a foundation of sand. The data is in. They just don't work. Which, of course, leads us to the next big question, why? Why are the experts so bad at this? Okay, now this is where it gets really fascinating. Because the problem isn't just that the market is complicated. A huge part of it is rooted in the psychology of the forecasters themselves. So, this guy, Philip Tetlock, he conducted the most exhaustive study of expert predictions ever. We're talking 25 years, 82,000 predictions. And his findings? Total bombshell. First, the experts were barely any better than a coin flip. But here's the real kicker. The more confident an expert was, and the more famous they were, the worse their predictions turned out to be. It's a completely backwards relationship. Think about that. I mean, the disconnect is just stunning. When Tetlock's experts said they were over 80% confident in a forecast, they were still right less than half the time. This is the danger of hubris, plain and simple. Their internal feeling of being sure has absolutely zero connection to their actual accuracy. So you might be wondering, how do some of these famous forecasters get credit for calling a big crash? Well, this quote sums it up perfectly. They're like a broken clock. They've probably been a perma-bear or a perma-bull for years, just making the same dire prediction over and over again. And eventually the market happens to align with their one-note song, and suddenly they look like a genius. But it's not skill, it's just luck. But it's not just about the psychological flaws of the experts. The entire system on Wall Street is structured in a way that makes honest, accurate forecasting pretty much impossible. Just look at this trend. It's stunning. Back in the early 90s, for every sell call analysts made, there are about 6 buy recommendations. Fast forward to the year 2000, at the very peak of the tech bubble, and that ratio had exploded to 50 buy recommendations for every single sell. 50 to 1. So what was driving this insane optimism? Well, the reasons are baked right into the system. It's all about the incentives. Analysts work for firms that make money when you buy stocks. A sell call, that generates 0 commission. And on top of that, if an analyst gives a company's stock a bad review, guess what? That company might just cut off their access to important information. The incentives are completely perverse. That analogy says it all. It's like a weatherman getting paid based on how many umbrellas he sells. But you know what? We can't just point the finger at Wall Street. As the legendary investor Ben Graham pointed out, we have to look in the mirror. We, the investors, are actually part of the problem. We create the demand. We want someone to tell us what's going to happen next. And the industry? They're just supplying that demand, even if the product they're selling is completely useless. Okay, so let's recap. The system is broken. The experts aren't really experts, and our own brains are wired to listen to them anyway. So what on earth are we supposed to do? Let's talk about a whole new way to think, a new mental model. Here's the thing about our brains. They're fundamentally lazy. They're hardwired to conserve energy, so they're always looking for shortcuts. You can call it cognitive cruise control. And this is wild. MRI studies have actually shown that when we listen to a so-called financial expert, the parts of our brain responsible for reasoning, they literally start to shut down. Let me put this as plainly as I can. The moment you turn on a market guru and listen to their predictions, you stop thinking for yourself. You are literally outsourcing your critical thinking and letting them take the wheel. And as we've just spent this whole time proving, that is a terrible, terrible idea. So what can you do starting right now? Here is your new, simple 3-step playbook. Step 1, think. The second you hear a prediction, just repeat this to yourself. This person has no clue. Seriously, it breaks the spell. Step 2, ask. Is this projection based on any actual research? What is this person's real track record? And finally, step 3, do. Act on timeless principles and proven systems, not on wild guesses about a future that nobody can possibly know. And that brings us to the final thought I want to leave you with today. We've seen, without a doubt, that the financial crystal ball is completely, totally broken. It always has been. So the real question for you is this. How are you going to stop looking into that broken crystal ball and start using a reliable compass instead? All right, let's dive into a really powerful, timeless idea. No matter how amazing things get or how terrible they seem, no extreme ever lasts. And believe me, this one single concept governs just about everything, from our own lives to the entire global economy. And this idea isn't new at all. The Roman poet Horace just nailed it perfectly more than 2,000 years ago. This one line, it's really the core wisdom that's going to guide us through this entire explainer. It's this constant reminder that fortunes are always in motion. So what on earth could an ancient fable about some king's magical ring possibly have in common with a modern curse that seems to haunt the biggest names in sports? Well, the connection is way more profound and honestly more scientific than you might think. It all kicks off with that famous phrase, "This too shall pass." You can trace its origins all the way back through Sufi poets and these old fables of Eastern kings. One of the best stories is about a king who wanted a ring that would make him happy when he was sad. And yeah, the phrase worked, but it also had this unintended side effect. It made him sad when he was happy. It was this powerful lesson in just how temporary everything is. Even Abraham Lincoln used it to explain how it humbles us in our pride and comforts us when we're down. Okay, so we've got this ancient piece of wisdom about the natural ups and downs of life. Now let's connect it to something a little more current. What in the world does any of this have to do with one of the most stubborn superstitions in all of sports, the dreaded Sports Illustrated cover jinx? I mean, the evidence for the jinx feels pretty real, doesn't it? Back in 2003, both the Cubs and the Red Sox get on the cover during these incredible playoff runs, only to suffer these spectacular, heartbreaking collapses. Or how about Michael Spinks? He gets the cover right before fighting Mike Tyson and gets knocked out in 91 seconds. And when the legendary core four of the Yankees were featured, 3 of them were on the disabled list within a week. You can kind of see why people believe in a curse, right? So, is there really some kind of voodoo going on here? Is the magazine cover itself some kind of bad luck charm? Well, the truth is actually far more logical and, frankly, way more useful to understand. There is a powerful scientific force at play. Yeah, the secret behind the curse isn't magic. It's a core statistical principle. So let's talk about the science of the average. And that force is called mean reversion. It's just the natural tendency for things to drift back toward their long-term average. I mean, think about it. An athlete only gets on the cover of Sports Illustrated because they are having an unbelievably good, way above average season. Statistically speaking, an exceptional performance is almost always followed by a more normal or average performance. It's not a jinx. It's like statistical gravity pulling them back down to earth. The Nobel Prize winner, Daniel Kahneman, said that once you really get this concept, he calls it regression, you start seeing it absolutely everywhere. It's not a quirk, it's a fundamental pattern of reality. And this is a brilliant illustration of how we get it wrong. So Kahneman was working with the Israeli Air Force, where instructors noticed this really weird thing. Whenever they praised a pilot for a perfect maneuver, their very next performance was often worse. So they concluded that praise actually hurts performance. But the reality was just simple mean reversion. A perfect maneuver is an extreme event. The next one was just more likely to be closer to average, whether they got praise or criticism. It's a classic case of mixing up correlation with cause and effect. So, if this principle governs sports performance and even fighter pilots, you can bet it has massive implications for another world filled with extreme highs and lows. Let's talk about Wall Street's ironclad rule. I mean, this is such a powerful statement from the investor James O'Shaughnessy. After digging through mountains and mountains of data, the single most reliable, ironclad rule he could find was reversion to the mean. This isn't some niche theory. It's arguably the single most dominant force in financial markets. And this slide just demolishes a really common myth. The famous business book Built to Last identified these supposedly visionary companies. And yeah, before the book came out, they were absolutely crushing the market. But what happened after they were crowned excellent? Well, their performance regressed right back to average. And over the long haul, they actually underperformed the market. Turns out, even corporate excellence is temporary. And this reversal of fortunes is just stunningly clear when you look at the data. Studies have looked at the best performing stocks, the winners, and the absolute worst performing stocks, the losers. And what happens next is this shocking flip. The recent winners go on to underperform the market, while the recent losers, they go on to outperform by a massive 17%. Today's darlings so often become tomorrow's disappointments, and vice versa. So, now let's look at what happens when an entire market completely forgets this ironclad rule. The consequences, well, they can be catastrophic. This is when excess creates bubbles. And just to give you a sense of what true mind-bending excess looks like, in the late 1980s, the real estate in Tokyo alone was valued at 4 times more than all of the real estate in the entire United States. Think about that. An entire country's worth of land valued at less than a single city's. That is the very definition of an unsustainable extreme. So what fuels this kind of crazy thinking? It's that dangerous belief that this time is different. And what makes bubbles so seductive is that they often start with a revolutionary idea that's actually true. The internet really did change the world. But that truth was taken to an irrational extreme where companies with 0 sales were suddenly being valued at billions of dollars. And as the historian J.K. Galbraith noted, the world of finance has a notoriously short memory. It seems like each new generation thinks they've discovered some new secret to permanent wealth, and they just dismiss all past experience as irrelevant. This collective amnesia is exactly why bubbles are a recurring feature of markets. So, the crucial point is this, and it's completely counterintuitive, so listen close.
Most people think risk is highest when the markets are crashing. But the truth is, risk is created in the good times. It's born in periods of euphoria, when prices are sky high and everyone believes the good times are going to last forever. The crash is just when all that hidden risk finally becomes visible. Okay, so we've seen the problem, we understand this powerful force of mean reversion and the dangers of ignoring it. Now for the most important part, what do you actually do about it? Here is your contrarian playbook. It's a pretty simple 3-step plan. First, you have to think. You have to internalize that ancient wisdom. This too shall pass. Whether things are euphoric or miserable, you have to remember, it is temporary. Second, you have to ask. When everyone assumes today's trend is forever, you ask yourself, has this created an opportunity to do the exact opposite? And third, you have to do. Prepare for bad times when things are good and have the courage to act when everyone else is freaking out. To put it all into one simple sentence, your job is to be the rational one in the room. Be an optimist when everyone else is forecasting gloom and doom, and be a cautious, skeptical historian when everyone else is popping champagne and celebrating. And that really leaves us with a final question. It's pretty easy to be a pessimist in a crisis, but it is much, much harder to be cautious when everyone around you is getting rich and having a party. So, in that time of champagne and roses, will you have the courage to be the wet blanket? Because, as we've learned, excess is never permanent.
All right, let's jump right into a huge paradox in the world of finance: diversification. We're always told it's the #1 rule for any investor, to protect yourself from risk. But if that's really true, why do the wealthiest people on the entire planet seem to do the exact opposite? Okay, let's really get into this, because the answer tells you something absolutely critical about how wealth is not only created, but also how it's kept. When you peek at the Forbes 400 list of the richest people, you start to see a pattern. There's one thing they pretty much all have in common. They didn't get to where they are by spreading their money out over hundreds of different stocks. Nope, they got unbelievably wealthy from a super concentrated position, usually in one single company they either started or totally transformed. And that, right there, is the heart of it. Concentration is a total double-edged sword. It's, without a doubt, the fastest way to get to that insane, world-changing level of wealth. But, and this is a big but, it is also the fastest train to losing absolutely everything. They're just two sides of the very same coin. So before you get any ideas about going all in on one stock hoping you're going to be the next billionaire, let's just take a minute and look at the cold, hard reality of this high-stakes game. The odds, well, they're probably not what you think they are. Just let this number sink in for a second. 64%. That is the percentage of individual stocks that actually underperform a simple market index over their entire lifetime. That means if you just pick a stock out of a hat, the odds are already pretty stacked against you. Now, what's so fascinating here is when you see the whole picture from that study. Just look at this distribution. A huge number of stocks, nearly 40% in fact, actually lose money over their lifetime. And all those big gains the market is famous for, they come from that tiny, tiny sliver of superstar stocks way over on the right. Trying to pick one of those, it's literally like finding a needle in a haystack. So here's the bottom line. While it's so easy to dream about betting it all on the next big thing, the data is crystal clear. You are about twice as likely to go completely broke on that one stock as you are to strike it rich. That's a gamble most of us just can't afford to make. And that is exactly why diversification exists. And look, this isn't some fancy new idea from Wall Street. It's actually an ancient strategy, a behavioral tool for dealing with one of the most powerful emotions we have, regret. And you can see this idea has been around for literally thousands of years. Way back in 935 BC, the Book of Ecclesiastes advised people to divide their investments among many places because you just don't know what risks are out there. The Talmud suggested splitting things 3 ways. Even Shakespeare wrote about not putting all your fortune on one ship. See, this isn't really about finance theory, it's about human nature. When you boil it all down, that's what diversification really is. It's applied humility. It's you admitting, hey, I can't predict the future, so you prepare for a bunch of different outcomes. It's a strategy that's not just about making money, it's about managing fear and, maybe most importantly, avoiding that gut-wrenching feeling you get from a catastrophic loss. And wow, does this quote nail it. The tennis legend Andre Agassi just perfectly captured the psychology here. Studies totally back this up.
We humans feel the sting of a loss way more deeply than we feel the joy of an equal gain. It's called loss aversion, and it's the reason why avoiding those huge losses is so much more important for our long-term sanity than just chasing huge gains.
Okay, so if diversification pretty much guarantees you'll always have something in your portfolio that's not doing so hot, meaning you'll always have to say you're sorry about something, how in the world does it actually work? Well, the math behind it is surprisingly powerful.
Let's look at the lost decade from 2000 to 2009. If you were only in big U.S. stocks, you actually lost 1% a year. Ouch. But a simple diversified portfolio, a mix of U.S. and international stocks, bonds, real estate, it returned a positive 7.2% per year. So while one part of your portfolio was sinking, the other parts were keeping you afloat. That's diversification in action.
But there's this other sneakier reason it works. It's a concept called reducing variance drain. Okay, picture two investments. They both start with $100,000, and they both average a 10% annual return. The only difference is that one is a smooth, steady ride, while the other is a crazy, high-volatility roller coaster.
So let's follow the money. The smooth portfolio goes up 10% each year, and you end up with $121,000. Easy enough, right? Now, the roller coaster portfolio drops 20% in that first year, down to $80,000. Then it has a monster 40% rebound in year two. The average return is still 10% a year, just like the other one. But look at the final number, only $112,000. So what happened? Well, that big 40% gain was growing from a much smaller base.
That difference, that $9,000, is the cost of volatility. It's the variance drain. By just smoothing out the ride, diversification helps you avoid those really deep drops, which lets your money compound more powerfully over time, and that leaves you with more cash in the end.
So, what's the big takeaway from all this? Well, in a world that's only getting more complicated and more connected, diversification is actually more important and, honestly, more challenging than it's ever been.
But here's the catch in today's world. Globalization is making it tougher to find things that don't all move in the same direction. When one market catches a cold, it feels like the whole world starts to sneeze right along with it. And you can see it plain as day on this chart. Before the year 2000, the correlation between US and world stocks was around 0.4. Since then, it shot up to over 0.8. That just means they move in lockstep way more often, which kind of reduces the benefit you get from just adding international stocks.
And yet, even with these challenges, the main principle is still rock solid. Its power is so fundamental that hedge fund manager Cliff Asness famously called it the only free lunch in investing. Think about it. It's one of the only strategies that can potentially boost your long-term returns while lowering your risk.
So, what should you do with this? First, just always remember that get rich fast and get poor fast are basically the same thing. Second, think about diversifying beyond just your money. Ask yourself, how can I diversify my skills to protect my career? And finally, the practical step. Build a portfolio that spreads your risk across different kinds of assets. Because at the end of the day, while concentration might be how you build a fortune, diversification is how you keep it. So what's the biggest risk you're taking right now that you haven't diversified?
What if the single biggest idea Wall Street ever sold you was, well, a lie? Today, we're going to talk about risk and why almost everyone gets it completely wrong.
Okay, so let's just dive right in. This quote from Mark Twain, it's just perfect, right? He absolutely nails that universal anxiety we all feel about investing, that it's this minefield where danger is just lurking around every single corner. But here's the thing, what if we're looking for risk in all the wrong places?
To really get our heads around this, let's actually start somewhere you wouldn't expect. Not on a trading floor, but in a therapist's office. And it's a story about a PhD student named Brooke who was just completely paralyzed by the very idea of risk.
So, Brooke was this brilliant student, right? She'd spent her entire academic life preparing for this one single moment. And these 6 letters, they held the verdict on all of that incredible hard work.
But instead of finding out what was inside, she just stopped. Can you imagine? The deadlines to accept an offer were right around the corner, but the fear of seeing even one rejection letter was so overwhelming that she chose to do nothing. And in doing that, she basically guaranteed she'd miss out on every single opportunity. And this is where it gets really interesting. Here's the breakthrough from her therapist. By being so afraid of the possibility of failure, she guaranteed actual failure.
I mean, wow. This is a perfect parallel for how so many of us approach investing. And it all boils down to this deeply flawed definition of risk we've been taught. So that brings us right to Wall Street's doorstep. Because in the world of high finance, the official definition of risk has this huge and honestly often damaging impact on how we all behave. You see, in finance, risk is officially defined as volatility. Yep, that squiggly line on a stock chart. And you might ask, why? Well, mostly because it's convenient. It's a nice clean number you can measure and plug into all these fancy mathematical models. But let's be real for a second. Does that number really capture that deep-seated, gut-wrenching fear we all have about losing our money for good?
So, what are we really afraid of when we talk about investing?
Well, the legendary investor Howard Marks just hits the nail on the head here. People aren't afraid of the up and down squiggles. They're afraid of the permanent loss of capital, right? They're afraid of not having enough money for retirement or for their kids' education. That is the real risk.
You know, Warren Buffett's own mentor, the great Benjamin Graham, he put it perfectly. A drop in your portfolio's value, that's just a paper loss. It's not real yet. The risk only becomes real, truly real, if you panic and sell at the bottom. That's when you turn a temporary dip into a permanent loss.
Okay, so once we make that mental shift, once we redefine risk as the permanent loss of capital, well, the historical data tells a completely different story, and frankly, it's a much more optimistic one.
Let's just look at the hard numbers for a second. Get this. Over every single 30-year period since the late 1800s, stocks have delivered an average real return of a whopping 7.4%, and that's after inflation. Now, let's look at the so-called safer assets. Bonds, they barely kept up at 1.4%. And cash? Holding cash actually lost you money to inflation. So I have to ask, looking at this, which one is truly the riskier asset for your long-term goals?
And this chart, wow. This just brilliantly illustrates how our own behavior creates the feeling of risk. Think about it. If you check your portfolio every single day, you're going to see a loss about 41% of the time. That feels terrifying, right? But what if you only looked every 12 years? You would have never seen a loss, not once. Your time horizon completely, totally changes the game.
Okay, so if we agree we shouldn't be obsessing over the market's daily squiggles, what should we be focusing on instead? Where should we put our energy?
Well, the great financial historian Peter Bernstein gave us the answer. It's simple, really. Focus your energy on the things you can actually control and learn to just tune out the noise you can't, like, the market's daily mood swings.
So to make this super practical, let's use a really simple analogy. I want you to imagine you're not buying a stock, you're investing in a neighborhood lemonade stand.
You wouldn't walk up and ask about its daily price fluctuation, would you? No way. You'd ask about the fundamentals. You'd ask, how good is the lemonade? What are the profit margins? Who's in charge here? How much do the lemons cost? Is there a secret recipe? You'd be assessing the risk of the actual business, not the fickle day-to-day feelings of people just walking by.
And this right here, this leads us to the absolute core of what real risk management is all about. Listen to this. The single biggest risk you can take isn't buying into a volatile market, it's overpaying for an asset. It doesn't matter how great the underlying business is. The price you pay is, quite simply, everything.
So this brings us full circle, right back to that scary squiggly line we started with. But now it's time to reframe it completely. It's not something to be afraid of, it's something to understand.
Okay, check this out. Since way back in 1871, the stock market has had a major swing. We're talking up or down by more than 20% in 2 out of every 5 years. Think about that. Big swings aren't the exception, they are the norm. Volatility is a feature of the system, not some kind of bug.
The philosopher Nassim Taleb has this brilliant analogy for this. He says, imagine a commuter who always gets home at 6 p.m. on the dot. If they're 5 minutes late, you start to worry, right? But what about a commuter who usually gets home sometime between 5:30 and 6:30? You don't panic at all. And his point is, insisting on perfect, predictable stability actually makes the whole system more fragile.
And that really is the ultimate takeaway here. Volatility isn't the risk. You know what it is? It's the price of admission. It is the cost you have to pay for the superior long-term returns that lead to true, lasting financial stability. You can't have one without the other.
So the next time you see the market dropping and you feel that panic start to bubble up, the question to ask yourself isn't, how do I avoid this? No, the real question, the most important question, is this: am I controlling the controllables? Are you focused on the quality of the businesses you own? Are you focused on the price you paid for them? Because that is where real risk and the real path to building wealth truly lies.
So let me tell you about this one time. It started with a totally ordinary drive home from work, a completely normal commute. But a simple detour ended up revealing something pretty profound about human nature, especially when it comes to how we handle our money. We're going to dive into that surprising discovery right now. Okay, so picture this. You're on that familiar road home, the one you take every single day to decompress. You probably feel like you could drive it with your eyes closed, right? Well, on this particular day, something completely shatters that routine. And then, bam, a tanker spill blocks all 4 lanes of traffic. Your usual route is just gone. You're forced to improvise, to start navigating through streets you don't normally drive down. And this new route, it takes you right past the biggest hospital in the whole region. A super respected place, great reputation. As you're driving right between its main buildings, you see something you just do not expect. You look over and you spot this group of medical professionals out on a nearby lot. They're still in their scrubs. And you can't help but count them. 1, 2, 3. There are 13 people standing there. And here's the kicker. Every single one of them is smoking a cigarette. We're talking doctors and nurses, the very same people who, in just a few minutes, are going to be back inside advising patients to quit smoking for their health. They know the risks better than anyone on the planet, and yet, there they are. This contradiction, this disconnect between knowing what's right and doing it, it actually has a name. It's a struggle that every single one of us faces, a lot of times without even realizing it. It's called the knowing-doing gap. So what is the knowing-doing gap? Well, it's that giant chasm between our best intentions and what we actually do. It's knowing the right thing, the smart thing, but still, for some reason, not doing it. And listen, this isn't some abstract theory. It is painfully real and relatable. The author of our source material even admits it himself. He says he leaves the gym, feeling good, armed with all this knowledge about nutrition, and then immediately eats a bag of Skittles. Does that sound familiar to anyone else? I mean, this really breaks it down perfectly, doesn't it? We know we should be saving for retirement, but then we overspend. We know we should eat healthy, but we reach for the junk food. It's right there in that gap where so many of our financial goals and our personal ones just kind of fall apart. So this raises a really important question. If we're smart people and we have access to all this information, why do we keep making these same mistakes? The answer is actually pretty simple. Knowledge by itself is not enough. I absolutely love this quote from our source. It just cuts right to the heart of the issue. If just knowing better and wanting it were enough, well, things would look a lot different, wouldn't they? Clearly, there are more powerful forces at play here. Look, all the research, all the ideas, all the anecdotes we learn, they're super valuable for sure, but they aren't some magic bullet. Just knowing all the rules of smart investing won't automatically make you a smart investor. It's just not how it works. Okay, so if knowing more isn't the answer, then what is? How do we actually close this gap between what we know and what we do? Well, our source material suggests a really simple but powerful 2-part framework. It really boils down to 2 of the most important things you can possibly do. First, own your behavior, and second, get help. Let's break down exactly what that means. All right, let's start with rule number 1, own your behavior. This is all about having a radical focus, learning to separate the things you have absolutely no control over from the things you absolutely can control. Think about it. You can't control the economy of Greece. You can't predict what the global markets are going to do tomorrow. Wasting your energy there just leads to anxiety, not better results. But what you can control is how much you save each month, how you manage your day-to-day expenses, and your decision to take a long-term view. That's where your real power lies. And now for the second rule, which honestly might be the most crucial one of all. Get help. This just means recognizing that you don't have to, and you probably shouldn't, try to do all of this alone. And you really need to hear this. You could literally read every single investing book ever written and still end up with terrible results. Why? Because the financial world, what our source calls a Wall Street bizarro world, is designed to pull you toward making irrational decisions. Its pull is just that strong. Having the right support is your best defense. So when you put these two rules together, they become more than just a piece of advice. They become your personal guide to sanity in what is, let's face it, a pretty crazy-making endeavor. Let's just be real for a second. The investing world is often completely irrational. It's a place where doing less is often more, and where the patient few almost always outsmart the frantic many. It's not supposed to feel logical all the time. But here's the good news. That irrationality doesn't have to be your destiny. It doesn't have to doom you to bad returns. By owning what you can control and by getting the right kind of help, you can absolutely navigate this world and build the financial life you actually want.
And that really leaves us with one final and really important question to think about. In a world of money that is so often irrational, where our own psychology is constantly working against us, who's on your team? Who is helping you stay sane?
Welcome to the show. Today, we're going to dig into a really important truth in investing, one that's so easy to ignore. The quality of your process is just so much more valuable than a lucky payoff. And to really get why, we have to start with a kind of strange story. So what on earth does shampoo have to do with your stock portfolio? It seems like a weird question, I know. But believe it or not, it tells us something pretty fascinating about our own psychology and why we're always looking for that secret formula. Okay, so the story goes like this. Unilever is rolling out a new shampoo in Asia, but one marketer decides to get a little creative. They add something special to the label, a secret ingredient. And the funny thing is, the executives, the top brass, they didn't even notice. And this was it. Contains the X9 factor. I mean, it sounds pretty official, right? Kind of scientific, powerful, like it's a game changer. There was just one tiny problem with it. The X9 factor was completely 100% made up. It wasn't real. So here's where it gets really wild. The first batch with the fake ingredient sells out. Unilever prints the new labels without it because, it was never real in the first place. And what happens? They get a ton of complaints. People were saying their hair wasn't as shiny anymore, that the shampoo just wasn't the same. They believed in that magic ingredient so much, they literally felt the difference when it was gone, even though it was never there at all. And that shampoo story? Well, it's the perfect setup for our first big idea, the X9 factor myth. And this is not just about shampoo. It's about that part of us that's always looking for a secret weapon, a hidden edge. You see, for years and years, Wall Street has been selling its own kind of X9 factor. It just comes in a different bottle. It's these super complex products, these strategies with fancy names, all promising some secret formula that only the pros know. They're making something that should be pretty straightforward, not easy, mind you, but straightforward, into this big, confusing mess. So why do we keep falling for it? Why do we want to believe in these financial X9 factors? Well, it's because we make a really basic mistake in how we think. We get a good outcome confused with a good decision. Just think about it for a second. Have you ever made a really bad call, but somehow it all worked out in the end? Yeah, we all have. The big danger, though, is that those moments teach us the absolute worst lessons. Let me give you an example. Picture a busy blackjack table in Vegas. A guy gets dealt a 17. Now, anybody who knows the first thing about blackjack knows what you do here. The book, the odds, everything says you stand. You don't take another card, period. But this guy, he just leans in, cool as can be, and says he wants a hit. He wants another card. The dealer is so surprised he even asks, "Sir, are you sure?" But the guy nods, and the dealer flips the card. And you know what happens next? Boom, a 4. He makes a perfect 21. The whole table just explodes. People are cheering, high-fiving him. Even the dealer smiles and says, "Nice hit." So let's just pause on that. He made the worst possible decision, statistically speaking, and he got celebrated like a genius for it. And that, right there, is the whole point. Just because you got lucky doesn't mean you made a good decision. The process was completely wrong, even if the result was a jackpot. Actually, the source material for this whole idea puts it a lot more bluntly. The phrase is, you can be right and still be a moron. You know that one friend who put all their money on a meme stock and it paid off? Lucky moron. The person who sold all their investments because they had a bad feeling right before a dip? Yep, also a lucky moron. You just can't build a real, repeatable strategy on dumb luck.
Okay, so if we shouldn't be the gambler making terrible but lucky decisions, who should we be? Simple. We should be the house. It's time to start thinking like a casino.
And right here, you can see the huge difference in mindset. The gambler is all about gut feelings, emotions, chasing that one big, life-changing win. The casino? It's a machine. It's totally disciplined. It could not care less about winning one hand of blackjack. All it cares about is using its tiny, statistical edge over and over and over again, thousands of times a day.
There's this great quote from Dr. Wes Gray that just nails this idea. He says the real power isn't in some secret trick. It's in the relentless exploitation of edges. It's about finding one small advantage and just hammering it, again and again with total consistency.
And when you look at the actual numbers, it's kind of shocking. The casino's edge is tiny. I mean, in blackjack against a good player, it's only 0.5%. But when you multiply that tiny edge by millions of hands played, well, that's how they build those giant, glittering buildings in the desert. They win because of their process, not because they have some massive advantage on any single bet.
Okay, so this brings us to the most important question of all. How do we as investors find and use our own small edge? How do we become the casino?
Well, the solution proposed here is something called rule-based investing, or RBI. And the whole point of this isn't to be smarter than the market. It's to build a system that saves you from your own worst enemy, which, let's be honest, is usually yourself and your emotions. It's all about sticking to your plan, no matter what your gut is screaming at you to do. And it really just boils down to 3 simple steps. First, you find a small, proven edge, something like investing in value stocks or following momentum. Second, you apply it with that casino-like, relentless consistency. And third, and this is by far the hardest one, you have to learn to ignore the short-term noise. Ignore the random good results and the random bad results.
Now, all of this sounds pretty logical, right? So why is it so ridiculously hard for us to actually do it? And that brings us to our final and maybe the most important point: why boring wins. The Nobel Prize winner Daniel Kahneman identified this powerful little glitch in our brains he called hindsight bias. It just means we're wired to judge a decision based entirely on how it turned out. If it worked out well, we think, oh, that was a brilliant move. If it didn't, we think, what a dumb idea. This bias makes sticking to a process almost impossible.
And here's the big paradox, the really wild part of all this. If there was a system that worked perfectly 100% of the time, guess what? Everybody would use it, and poof, the advantage would be gone, instantly. The very thing that makes a disciplined process work over the long haul is that it doesn't work all the time. Those painful periods when you're watching your strategy lose money and it feels awful, that's not a bug, it's a feature. That pain is what scares everyone else away and keeps the edge alive for those who can stick it out.
So I'll leave you with one final question to ask yourself. When you look at how you invest, is your strategy built like the casino, designed for long-term winning with a disciplined process? Or is it built more like the gambler, designed for the short-term feeling, just chasing that next lucky win?
All right, let's talk about a giant in the financial world, passive investing. For years, it's been praised as the smartest, safest, go-to choice for millions of people. But today, we're going to pull back the curtain and look at some of the hidden flaws in this super popular strategy.
So let's just cut right to it with the one big question that's going to guide us through this whole explainer. What if the one strategy that everyone tells you is the safest is actually hiding some pretty big risks you haven't thought about?
First things first, before we start poking holes in it, we've got to understand why passive investing is so popular in the first place. And let's be real, there are some very, very good reasons it became king of the hill.
At its heart, the idea is really simple. You're not trying to be a genius and beat the market. You're just trying to be the market by buying a fund that copies an index. And this whole philosophy is built on this big academic idea that the market is efficient, meaning all the information is already baked into the stock price, so trying to find a hidden bargain is basically a fool's errand.
Now, the number one biggest, most celebrated advantage of passive funds, they are just so cheap. You know, fees are like a slow leak in your financial tire, and as you can see here, even a tiny-sounding 2% fee can literally eat up hundreds of thousands of dollars from your returns over your lifetime. Passive investing pretty much solves that problem.
And it isn't just about the cost, it's about the results. I mean, get this.
Over a decade, a mind-boggling 82% of those highly paid professional stock pickers, they failed to beat a simple, boring old passive index. Lower fees and better results? Yeah, you can see why this became the default advice for everybody.
So case closed, right? Passive investing wins. End of story. Well, not so fast. Let's start digging into the actual theory this whole thing is built on. And you're going to start seeing some pretty serious cracks in the foundation.
Okay, so this is the bedrock, the big idea from academia, the efficient market hypothesis. The core belief is that the market price is always the correct price because it just instantly sucks up all the available information. But is that really how the world works? And of course, you can leave it to Warren Buffett to cut right through all the jargon with some good old-fashioned common sense. He nails the problem perfectly. Just because the market is often efficient doesn't mean it's always efficient. And, that little gap between often and always, that's where all the danger and all the opportunity lives. History is just littered with moments when the market went completely bonkers. I mean, think about this. Back in the 1600s, people in Holland were literally trading their houses for a single flower bulb. Was that the right price? Of course not. It's a classic example of prices just getting totally disconnected from any kind of reality.
And in case you're thinking, well, that was ancient history, let's jump to the dot-com bubble. eToys.com, a company that was losing money hand over fist, was somehow valued at $8 billion. At the same time, the profitable, well-known industry leader, Toys R Us, was valued at less than that. That wasn't efficiency, that was pure mania. And it ended with eToys going bankrupt.
Okay, so the core theory is a little shaky, but what about the index itself? I mean, the S&P 500 is just a list of the 500 biggest companies, right? It's totally objective. Well, that assumption is what leads us to what you could call the passive illusion.
Seriously, think about it for a second. When you buy that S&P 500 fund, who is actually choosing the stocks that go into it? Is there some pure mathematical formula that decides who gets in and who gets kicked out?
And here's the kicker. The answer is it's not a formula at all. The S&P 500 is actually controlled by an anonymous committee making subjective judgment calls behind closed doors. They're the ones deciding. So what you think is passive, it's really just active management wearing a disguise.
And this just shows you how that committee gets caught up in the hype just like everyone else. In '95, they were pretty much ignoring tech stocks. But by 2000, right at the tippy top of the bubble, they were chasing the hot trend, cramming dozens of popular and often unprofitable tech companies into the index.
And the result of them chasing that trend? It was an absolute disaster for everyday investors. While the S&P 500, which was now stuffed with all those overvalued tech stocks, lost 20%, the average stock in the market actually gained 20%. The committee's active decisions drove investors right off a cliff.
But believe it or not, it actually gets worse. It's not just about some secret committee. There's an even bigger, more fundamental flaw that's literally programmed into the DNA of the most popular index funds. Okay, this slide right here is the absolute heart of the problem. We all know the first rule of investing, right? You buy low and you sell high. Well, most index funds are what's called cap-weighted, which means they are mechanically forced to do the exact opposite. They automatically have to buy more of a stock as its price goes up and it gets bigger, and they have to sell it as its price goes down. They are systematically designed to buy high and sell low.
So what does this glitch mean for you? It means the system forces you to pile your money into the most popular, most crowded, and often most overpriced parts of the market. It's why index investors were nearly 50% in tech right before it crashed in 2000. It's why they were almost 40% in financials right before the 2008 crisis. It pretty much guarantees you have the most money at risk right before the bubble's about to pop.
So, if the whole theory is flawed, and the process isn't really passive, and the mechanics force you to make bad decisions, what on earth is a better way? Let's talk about an approach that actually works.
Now, the obvious answer might seem to be active management, but we already saw the stats on that. With their high fees and the fact that professional managers are just as human and emotional as the rest of us, active management, on average, is a losing game too.
So that kind of leaves us looking for a third way, right? What if you could combine the best parts of both worlds? That's the idea behind an approach called rules-based behavioral investing. Basically, it's a system that keeps the good stuff from passive, like low fees and diversification, but it uses a clear, unemotional set of rules, like buying what's cheap and selling what's expensive, to avoid all the human biases and mechanical flaws we've been talking about.
And that really brings us to the final question you should ask yourself. At the end of the day, standard passive indexing is, by its very definition, a strategy that's built to follow the crowd, wherever it goes. And the real question is following the crowd the best way for you to reach your goals? Thanks for tuning in.
You know, when it comes to investing, we spend a ton of time analyzing markets and picking the right stocks. But what if I told you the single biggest threat to your portfolio is you? Today, we're diving into something called behavioral risk. It's this hidden force that can totally derail even the smartest financial plans. This quote right here really gets to the heart of it all. See, we're trained to think about risk as something external, a market crash or a company having a bad quarter. But this completely reframes the conversation. It suggests the most dangerous risk of all actually comes from within us, that it's a failure of self. For decades, the big debate in investing has been active versus passive strategies. But honestly, that whole conversation might be missing the real point. The actual question isn't if you're an active investor, because let's be real, you are every time you make a choice. The real question is how you can avoid being your own worst enemy in the process. So this table breaks down the 3 core types of risk. The first 2 are probably familiar. You've got systematic risk. That's when the whole market sinks, right? A sinking tide lowers all boats. Then there's unsystematic risk, which is when one specific company hits the skids. But it's this third one, behavioral risk, that's so often ignored, the very real danger that our own actions are what end up causing us to lose money for good. And that brings us to a really critical idea. Before we can even think about managing this internal risk, we have to define it. We have to be able to see the monster clearly. After all, you can't fight a monster you can't see. And here it is, the formal definition. It's simple, but man, is it powerful. Look at the key phrase there, your actions. Behavioral risk isn't some outside force that just happens to you. Nope, it's the potential for your own decisions, your own biases, and your own emotions to permanently wreck your wealth. This diagram here really lays out the path forward for us. And you'll see, it all starts with definition. You just can't build a better process until you know exactly what it is you're up against. So let's really focus on that crucial first step, getting a handle on the entire universe of behavioral risk. So how in the world do we get our arms around this massive concept? Well, the source material for this explainer does it brilliantly. It groups all the countless ways we can shoot ourselves in the foot as investors into a simple but really powerful framework. And here they are, the 5 core dimensions of behavioral risk: ego, emotion, information, attention, and conservation. Think about it. The number of bad decisions we can make is practically infinite, but this framework suggests they all stem from one or more of these 5 root causes. So, let's take a quick tour of these 5 flaws. Now, the goal here isn't to judge ourselves. It's about recognizing the patterns in our own thinking, because seeing those patterns, that's the absolute first step to managing them. All right, first up, ego risk. This is all about our deep, deep need to feel competent. You know, that feeling that we're smart, we're in control, and we know what we're doing. So the thing is, our ego's need to be right often gets in the way of doing what's right. This pops up as just plain overconfidence in our own genius, or as confirmation bias. That's when we only look for information that backs up what we already believe and totally ignore anything that might challenge our brilliant idea. Next up, we've got emotion risk. And this one feels pretty familiar, doesn't it? We've all been there, making big money decisions when we're either feeling totally terrified or completely euphoric. Our feelings completely change how we see risk. When the market's flying high, optimism bias can trick us into thinking we're invincible. But when it's crashing, we might fall victim to the ostrich effect, literally sticking our heads in the sand and refusing to even look at our brokerage statements. Our emotions are powerful, and they almost never lead to rational financial choices. Number 3 is information risk. Now, this isn't just about having bad information. What's way more interesting is how we process the data we do have. The key insight here is that our own minds can twist even the most perfect data. We might ignore basic probabilities, or we fall into the trap of thinking that more information is always better, even if it's just distracting noise. And maybe the most dangerous one of all is the blind spot bias, the tendency to see these flaws in absolutely everyone except ourselves. Okay, let's move on to number 4, attention risk.
I mean, think about it. Our brains can only consciously process a tiny fraction of the information hitting us every second. So where we point that little spotlight of attention is incredibly important. This is all about how our attention gets hijacked by things that are vivid and scary, not the things that are actually likely. It's why we worry way more about a super rare shark attack than the very real high-probability dangers of eating fast food every day. In investing, it means we get anchored to the price we first paid for a stock or let a scary headline dominate our thinking, even when the real, boring risks are hiding somewhere else. And that brings us to our final category, conservation risk. This one taps into our most primal instincts, our deep-seated desire to avoid loss and resist change at all costs. Here's a fact. The pain of losing $100 stings way, way more than the pleasure of gaining $100 feels good. That's loss aversion, and it's a massive driver of bad decisions, like holding on to losing stocks for way too long. We also just prefer for things to stay the same. That's the status quo bias. These forces create this powerful inertia that is just incredibly difficult to overcome. Okay, so we've met the 5 monsters: ego, emotion, information, attention, and conservation. That is a lot to fight. So how do we do it? Well, the answer isn't to just try harder or be more disciplined. The answer is to build a system. Look, trying to beat these deep-seated biases with sheer willpower is a losing battle. It just is. Willpower is emotional, it's totally unreliable, and guess what? It eventually runs out. But a simple, consistent process that's designed to work despite how we're feeling. It's our reliable defense against our very unreliable selves. And here are the building blocks for that very process, what the source material calls the 4 C's. Consistency frees you from emotion and ego because it forces you to do the same thing every time, no matter how you feel. Clarity fights information and attention risk by helping you focus only on the data that truly matters. Courageousness is what happens when you have a good process. It lets you act when everyone else is frozen in fear. And finally, conviction, which is built on that process, helps you beat that conservation risk, your fear of loss and change. It's a system designed to short-circuit our worst tendencies. So, we'll leave you with this final thought. You probably spend a lot of time thinking about your portfolio's exposure to market risk, right? But the far more important question might just be this. Do you truly understand, and more importantly, do you have a plan to manage its behavioral risk? Because at the end of the day, that's the one you actually have some control over.
Okay, let's just jump right in. When you think about investing, what's the big enemy? We all tend to point at the market, a shaky economy, maybe a failing company. But what if I told you the single biggest obstacle to your financial success is your own brain? Today, we're going to break down exactly why our minds are hardwired to make some truly terrible investment decisions and, more importantly, how a simple, rule-based approach can fix it.
You know, Oscar Wilde was a genius, no doubt about it. But when it comes to your money, he was completely, utterly wrong. We're always taught to value creativity, flexibility, and that spark of genius, right? But what we're about to see is that in the world of investing, that unimaginative trait he talked about, consistency, it might just be your greatest superpower.
All right, I know this is a tough pill to swallow. You think, but I went to a great school. Doesn't matter, a simple formula is probably better. But I read all the financial news every single day. A simple formula is still better than you. We just hate hearing that a process can beat a person, but the evidence is, well, it's overwhelming. And ignoring it is costing investors an absolute fortune.
So why is this true? What is going on in our heads that makes us so uniquely bad at navigating the world of finance? Let's get into the core of the problem.
While the Nobel Prize winner Daniel Kahneman laid out the exact conditions where our human intuition just spectacularly fails. And as you look at this list, it reads like a perfect description of the stock market, doesn't it? It's ridiculously complex, you never have all the information, your own goals can shift, it's super stressful, and you're constantly being influenced by what everyone else is doing. It's basically a perfect storm for making bad gut decisions.
I mean, think about it. Your intuition is great for everyday stuff. You touch a hot stove, you get immediate feedback. Ouch! You learn instantly. But investing is the total opposite. The feedback on a decision you make today might not come for months or even years, and the number of variables is just mind-boggling. You wouldn't want a pilot flying a 747 on intuition, right? No way! They use a checklist. Your money deserves that same disciplined approach.
Okay, so if our brains are the problem, what's the solution? Well, we're going to walk through 4 cures, and the very first one is consistency.
This is all about building a process and then having the discipline to stick to it no matter how scary or exciting the market gets.
This quote from the forecasting expert Philip Tetlock is just devastating for the human ego. What he's saying here is that across dozens and dozens of fields, we're talking everything from medicine to military strategy, simple models and algorithms consistently beat expert human judgment, and investing is absolutely no exception. Let's look at a real-world example from billionaire investor Joel Greenblatt. He tested his famous magic formula for picking stocks. Now, when he let investors use their own judgment, to add their own special sauce to the formula's picks, they earned a return of 59.4% over 2 years. Not bad, right? But they actually ended up underperforming the market.
But here's the kicker. What about the accounts that just blindly followed the formula, with zero human meddling? They returned 84.1%. By trying to be smart, by trying to add their own genius, investors literally threw away the best stocks. The simple, consistent process won, and it won by a landslide. And believe me, this isn't a one-off thing. A massive analysis of hundreds of studies found that models are as good as or better than expert human judgment, a staggering 94% of the time. Think about those odds. If you're betting on your own intuition over a proven process, you are playing a game you're almost guaranteed to lose. So that brings us to our second cure, clarity. If consistency is about sticking to the plan, clarity is about making sure that plan is wonderfully simple. In a world that's just drowning in data, simplicity isn't naive. It's a massive strategic advantage.
I love this timeline. It just brilliantly illustrates our natural bias for complexity. We invented the wheel 6,000 years ago. We literally sent a human being into space before we thought, hey, maybe we should put some of those wheels on a suitcase. We so often overlook the simple, elegant solution because we trick ourselves into believing that complex problems must require complex answers.
And this complexity, this overload of information, has real consequences. The explosion of financial media basically turned investing into a nonstop 24/7 video game. And as the amount of information shot up, our patience as investors just collapsed. The data shows that average stock holding periods have completely cratered, which leads to more trading and, historically, much worse returns.
More information can actually make us dumber. There's this famous study about Linda the bank teller. People were given a description of Linda. She's outspoken, she's bright, she's concerned with social justice. Then they were asked what's more probable, A, that she's a bank teller, or B, that she's a bank teller who is active in the feminist movement. Most people choose B, even though it's statistically impossible. The extra, compelling details made them totally ignore basic probability. Financial news does this to us every single day.
So how do you handle a system as complex as the market? Well, you don't try to match its complexity. You fight it with simplicity. Think about a dog catching a frisbee. That dog is not calculating trajectory and wind speed and spin rate. Nope, it's using a dead simple rule. Run in a way that keeps the frisbee at a constant angle in its field of vision. The more complex the system gets, the more robust and simple our rules need to be.
Our third cure is courage. But listen, this isn't about being fearless or reckless. In investing, courage means having a system that forces you to take views that are different from the crowd, and a system that helps you stay invested when every single instinct in your body is screaming at you to run for the hills.
So let me just ask you a simple question. If you want to get better than average returns, if you really truly want to beat the market, what is the one non-negotiable thing that you have to do?
That's it. That's the whole secret. You simply can't get above average results by doing what everyone else is doing. By definition, outperformance requires you to hold a portfolio that looks different from the average. It means buying what others are frantically selling. It means being willing to look wrong in the short term. As they say, you don't become a value investor for the group hugs.
Now, the other side of courage is just having the guts to stay in the game. Look at this research. Over a 30-year period, 95% of the market's entire gains came from just 90 trading days. 90! If your fear caused you to panic and miss just those 90 best days, your return would have been basically nothing. Sometimes, the courage to do nothing is the most profitable action you can take.
Okay, this brings us to our fourth and final cure, conviction. This is really where we put it all together. It's about finding that Goldilocks zone. Not too risky, not too passive, but a portfolio that is just right to give you a real shot at outperformance.
Think of it like this. Owning just one stock, that's pure hubris, that's too hot.
On the other hand, owning every single stock in an index fund, well, that guarantees you average returns. That's too cold. The just right approach is a convicted portfolio of somewhere between, say, 25 to 50 stocks. It gives you the potential to do better than average while still managing your risk.
And this might surprise you, but you really don't need hundreds of stocks to be well diversified. According to Joel Greenblatt's research, get this, owning just 16 well-chosen stocks can eliminate 93% of the risk that's specific to any single company. So you really can have a convicted, high-potential portfolio that is still incredibly safe from a diversification standpoint.
So, what's the big takeaway here? Here's your new toolkit. First, you have to change your thinking. Just accept that a good process will almost always beat a smart person. Second, ask yourself, how can I automate my decisions to get my own emotions out of the way? And third, just do it. Set simple, systematic rules for buying, selling, and holding, and then follow them slavishly.
And I'll leave you with this final thought. You know, so much of what passes for investing these days, the constant watching of financial news, the chasing of hot stock tips, the frantic trading, it isn't really investing, it's entertainment. So the question you have to ask yourself is this: are you here for the excitement of the game, or are you here for the results? Because a process built on consistency, clarity, courage, and conviction is how you get the results.
All right, let's just jump right in. Have you ever felt like you're at a total disadvantage in the stock market? Like you're playing a rigged game? Well, you're not wrong. But what if I told you the key to winning wasn't about having more secret information, but just a better mindset? Today, we're going to break down a really simple framework that's designed to give you exactly that. It's called the 5 Ps of equity investing. Wow, kind of harsh, right? But this isn't just some random insult. It's a message. And believe it or not, it's a message the market is sending you way more often than you'd probably like to think. Here's why. At its core, investing is a zero-sum game. I mean, for you to win, someone else has to lose. And what's kind of terrifying is that over 70% of the time, the person on the other side of your trade is a pro. We're talking about someone with more information, way better technology, and a whole team of analysts behind them. And you better believe they think they know something you don't. So how in the world can a regular person like you or me get an edge? We're never going to compete on speed. We're not going to compete on some secret inside access. The answer isn't trying to beat them at their own game. No way. It's about playing a completely different game. And this gets to the heart of what's called the investor's dilemma. See, the real challenge for all of us, it's not about finding some hot stock tip. It's a battle fought inside your own head. It's psychological, not informational. And this right here is the absolute key. Your single biggest advantage isn't in your brokerage account. It's between your ears. While all those pros are stressing about this quarter's performance and following the herd, your edge comes from something they often lack: discipline, patience, and the ability to just not make the same dumb behavioral mistakes that trip up almost everyone else. Okay, so how do we actually build that psychological edge? Well, it all starts with our very first P, price. The rule is simple: never overpay. Out of everything we're going to talk about today, this one is probably the single most important thing for managing your risk and, actually making money. And this is where our brains get so weirdly wired. Think about it. When you're buying a pair of shoes or a TV or pretty much anything else, what do you love? A sale. The cheaper, the better, right? We're all looking for a bargain. But then, when it comes to stocks, our brains just completely flip. We get all excited and euphoric when prices are sky high, and we get scared and depressed when they fall. It makes absolutely no sense. Warren Buffett, of course, had the perfect analogy for this. He said if you're going to be eating hamburgers for the rest of your life, you should be rooting for the price of ground beef to go down, not up. It's the exact same thing with stocks. If you plan on being an investor for years to come, you should be thrilled, absolutely thrilled, when the market goes on sale. And just look at this number. This shows you the incredible power of that one simple mindset shift. Some research looked at the period from 1963 to 2009. It found that if you had just systematically bought the cheapest value stocks, you would have turned $10,000 into, wait for it, $9 million more than the market average. The takeaway here is so clear. The price you pay is critical. And having the guts to buy when everyone else is scared, that's a superpower. Okay, but wait. Buying cheap isn't the whole story, right? Sometimes a stock is cheap for a very good reason, like the company is circling the drain. That's what we call a value trap. And that brings us to our second P, properties. The rule here? Always buy quality. Buffett said it best. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I mean, just think about the story of Blockbuster. Back in the early 2000s, its stock was just cratering. On paper, it probably looked super cheap based on a lot of metrics. But anyone who jumped in just because of the low price learned a really painful lesson, didn't they? A cheap stock is often just a bad company. Quality is everything. So how can we do this systematically? How do we separate the real deals from those value traps? Well, you can use a simple checklist, kind of like this one, which is based on something called the Piotrowski F-score. It just asks some really basic questions about the company's health. Is it profitable? Is its cash flow good? Is its debt going down? You don't have to be a CPA to figure this stuff out. You just need a system to make sure the business is solid and actually getting better.
Okay, so let's recap. We're looking for quality companies, and we're trying to buy them at a fair price. But you know what? Even if you do that, you can still get it wrong. And that brings us to our third P, pitfalls. This is all about actively thinking about risk. It's about flipping the script in your head. Instead of asking, why is this a great investment? You need to ask a much, much better question. How could this whole thing blow up in my face?
This is all about a little psychological demon called confirmation bias. We are hardwired to look for evidence that proves we're right. And get this, there's an expert on gullibility, a guy named Stephen Greenspan, who literally wrote the book on the subject, and then he went and lost a third of his entire net worth to Bernie Madoff. If the expert on not getting fooled can get fooled, what does that tell you? Even the smartest people can ignore massive red flags when they want to believe a story.
So the key is you have to actively fight this bias. Here's a practical way to do it. Before you pull the trigger on an investment, do what's called a pre-mortem. Use a checklist like this one. Ask yourself, where am I totally wrong about this? Go find people who disagree with you and actually listen to them. And maybe most importantly, write down your reasons for buying before you buy. That little bit of discipline is what turns wild speculation into smart investing.
All right, on to our fourth P, which is people. And look, a huge part of avoiding those pitfalls we just talked about is knowing who to trust. When it comes to the people running a company, here's the golden rule. Ignore everything they say. Watch what they do. Specifically, what they do with their own money. And why is that? It's because as a species, we're just awful, truly terrible lie detectors. I mean, check out this research. It's wild. Trained police investigators were actually worse at spotting lies on video than a bunch of random college students. It turns out that trying to read body language and all that stuff isn't just useless, it can actually make you less accurate.
So this is the real takeaway here. Everything a CEO says on TV, in interviews, in forecasts, that's just noise. The real signal is what they do. Are the insiders, the CEO, the CFO, buying their own stock with their own cash? Is the company itself buying back shares? Are they paying out a healthy dividend? Those actions, those are what tell you what they really believe about the business.
And that brings us to our fifth and final P. And honestly, this one might be the most surprising of all. It's called push, and it's all about going with the flow. We're talking about the power of momentum. Now, for a lot of value investors, this just feels wrong. But the data is undeniable. Momentum is one of the most powerful and persistent forces in the entire market. So what is momentum really? At its core, it's super simple. It's the idea that winners tend to keep winning and losers tend to keep losing, at least for a while. And it's all rooted in psychology. We tend to get stuck on old information and we're slow to react to new stuff. So winning stocks just keep on winning because it takes the market a while to catch up to all the good news. And this chart just shows you how incredibly powerful this is. Look, momentum on its own is great, but when you combine it with our first P, price, that's where the magic happens. A strategy of buying stocks that are both cheap and have strong upward momentum has historically just demolished the market. We're talking returns of over 19% a year. It's truly the best of both worlds.
So there you have it, the 5 Ps. It's a simple, repeatable system designed to give you that behavioral edge, letting you take advantage of everyone else's psychological mistakes. Let's run through them one last time. Price, never overpay. Properties, always buy quality. Pitfalls, actively look for risks. People, follow what insiders do, not what they say. And push, go with the flow of momentum.
Ultimately, this whole framework is about one thing:
It's about making you the house. Think about a casino. The house doesn't win every single hand of blackjack, right? But it doesn't have to. It has a disciplined process and a small statistical edge that, when repeated over and over, basically guarantees it's going to win in the long run. So the question I want to leave you with is this. Are you investing like the house? Or are you the drunken vacationer at the slot machine just pulling the lever and hoping for the best?
Today, we're diving into behavioral investing, and we're going to explore this really fascinating idea that the biggest battle you'll ever fight in the market, well, it isn't against other traders. It's against yourself.
You know, what Seth Klarman is getting at here is something so fundamental about investing. The hard part isn't really figuring out what you're supposed to do. The real challenge, the real test, is actually doing it when your money's on the line, and every single instinct in your body is screaming at you to do the exact opposite.
This conflict, this internal tug of war between knowing what to do and actually doing it, well, the writer Edwin Lefebvre had a great name for it. He called it the investor's duel.
And this, right here, just perfectly captures that gap between theory and reality. On one side, you've got the theory. You can read every investing book there is. You can know all the principles. That's like being able to snap a wine glass stem with a flick of your wrist. It's a neat skill. But can you do it when that same wine glass is pointing a loaded pistol right at your heart? Because that's what it feels like when the market is crashing and the raw fear of losing everything takes over. That's the duel. That's the real test.
So what's the root cause of this duel? Why is it so hard to act rationally? Well, it all stems from a basic misunderstanding of what finance even is. We love to treat it like physics, a hard science with neat rules. But it's not. It's a messy, chaotic, and totally unpredictable social science.
See, the early financial models, they made this huge mistake. Thinkers like Friedrich Hayek and Emmanuel Derrmann pointed this out. The models started with these big, abstract ideas, and they just completely ignored the individual people making the decisions. But the economy isn't some abstract machine. It's just a collection of us, of people. And if you really want to understand the market, you have to start with our psychology, warts and all.
This is maybe the best analogy for the human problem in investing, right? We have all the nutritional information we could ever need. We know we should save for the long haul. We know we should diversify. And we definitely know we should buy when things are cheap. That's the broccoli. It's the healthy, sensible choice. But then there's the donut. Chasing that hot stock, getting FOMO over some new trend, panic selling when things get scary, it just feels so much better in the moment. Our irrationality is just built in.
And here's the crucial point. This human fallibility, it's a constant. It's always there. Like Klarman says, even if we were all perfectly trained experts, we'd still get drawn into fads and bubbles because deep down, we can't help it. Now that's kind of bad news for our own portfolios, but it's fantastic news if we can learn to control ourselves, because it means the market is always creating these predictable opportunities. So this all brings us to a really counterintuitive solution, a rule-based behavioral investing approach. An approach that, get this, actually works because it's so difficult for most people to stick with.
Okay, so let's unpack this paradox. It sounds kind of crazy, right? How can a strategy's biggest weakness, the fact that it's sometimes going to fail, maybe even fail spectacularly in the short run, be the very thing that makes it so powerful over the long run?
Well, it works for two big reasons. First, like we've been talking about, it takes advantage of the totally predictable mistakes the crowd is going to make. But second, and this is the really clever part, a disciplined contrarian strategy is by its very nature going to underperform sometimes. And during those tough times, when the seas get stormy, all the impatient investors, they jump ship. And that leaves the entire field and all the eventual rewards for those who have the guts to stay the course.
And that's exactly what Benjamin Graham, the father of value investing, built his whole career on. The most effective strategies are often the ones that are unpopular. Why? Precisely because they demand a kind of patience and discipline that most of us just don't have.
The economist John Maynard Keynes absolutely nailed this idea. He pointed out this huge social pressure we all feel to just go along with the crowd. I mean, think about it. It's often safer for your reputation to lose money doing what everyone else is doing than to risk looking like a fool all by yourself, even if you turn out to be right in the end. Resisting that herd instinct is the core challenge.
But here's the thing. If you can master this approach, it offers a benefit that goes way, way beyond just financial returns. It forces you to look inward
And that can lead to some real personal growth.
And that brings up a really crucial question. When you learn about all these cognitive biases, all these mental mistakes people make, what's your first instinct? Is it to use that knowledge as a tool to spot the foolishness in other people, or do you use it as a tool to examine yourself?
Financial writer Jason Zweig gave us this really powerful metaphor. It is so easy to look out the window and judge the irrational crowd stumbling around down below. But the real courage, he says, is holding up the mirror and really staring at your own overconfidence, your own fear, your own biases, and then getting to work on overcoming them. That's where the real work is, and that's where the real reward is too.
So let's wrap this up by putting it all into a bigger historical context. Because what seems like brilliant common sense today often looks completely absurd tomorrow. I mean, for centuries, we were sure the Earth was the center of the universe. We thought health was all about balancing 4 bodily humors. Not that long ago, supposedly smart people practiced phrenology, believing the bumps on your head revealed your entire personality. All of these ideas seem ridiculous now, right? Which makes you wonder, will future generations look back at our current financial models, which mostly ignore human psychology, and see them in the exact same light?
The prediction here is pretty clear. The future of finance isn't about more complex math or faster computers. It's about a deeper, more honest integration of psychology. It's a future where we would never even dream of building a model that didn't account for the very people who make the market what it is. And so that leaves us with one final thought to chew on. We spend so much time and energy chasing financial returns. But what if the whole process of becoming a better investor by confronting our fears, our biases, our emotions, what if that offers a far greater prize? What if the ultimate return on investment is actually a richer understanding of yourself?